Well, good afternoon, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us today as we take a look at lessons from a grandmaster, anticipating key market moves. But before we actually get into the meat of the presentation, I'd like to introduce Pete Molmat. Pete is with the CME Education, and it's the CME sponsorship that's brought us today's event. Now, Pete, what I am going to do is let's move this over to your slides with a brief introduction about the products that Tim will be discussing later on in today's session. So, Pete, if you would please unmute your phone, I'm going to pass you the ball, and let's get started with a brief intro. Thanks for joining us, Pete.
Thanks so much, Cynthia, and thanks to everyone around the globe who's joining us today. CME Group is so pleased to be co-sponsoring this event with IB and extend a welcome to you for today's presentation, Lessons from a Grandmaster, Anticipating Key Market Moves with Tim Morse. CME Group and IB have been working together to bring you professional educational webinars on futures for many years, and we encourage you to look in IB's webinar archives for past events from 2012, 13, 14, as well as register to attend further monthly events. Just briefly, our disclaimer that there is risk in futures trading. Take a brief look. As a trader and investor, you're looking for opportunity in the markets and a way to capture that opportunity. Futures are an extremely flexible tool for expressing your market opinion and capturing trading opportunity. The CME Group futures and futures options markets trade electronically almost 24 hours a day, providing traders an opportunity to trade market volatility any time of the day from anywhere in the world. CME Group represents a family of individual exchanges, including the CBOT, the CME, NYMEX, COMEX, and the Kansas City Board of Trade Exchanges, with contracts covering all major asset classes, including foreign exchange, stock indexes, agricultural commodities, energy, metals, and interest rates. The CME Group is regulated by the U.S. CFTC, the Commodity Futures Trading Commission. As Tim shares his theory about staying ahead of the markets, he will be using the Canadian dollar. CME offers futures on the Canadian dollar in both a regular-sized or benchmark contract with a notional value of 100,000 Canadian dollars and trades at $10 a tick, as well as an E-micro contract, a tenth the size with a notional value of 10,000 Canadian dollars and trades at $1 a tick. The Interactive Brokers CME Group Futures Resource Center can be found at www.interactivebrokers.com/CME. It's a great place to start your day with news, quotes, charts, and all relevant product information for any of the products you'd be interested in trading. We have CME also in partnership with IB has put together for this year the School of Futures. We have our 4th session on the School of Futures coming up April 24th. And it's going to be an introduction to options on futures presented by Tom Boggs, a Senior Director in Equity Options Products. It should be a wonderful introduction into the availability of options on futures and how those products work. I hope you guys will take some time and register for this event. It will be well worth your time to participate. Tim Morse has been a professional trader, author, educator, and mentor for more than 35 years. Besides trading his own capital, Tim is president of Blackthorn Capital, a private money management firm that works with several of the largest non-U.S. institutional portfolios. In the 80s and 90s, he managed and taught other traders for institutions like Commodities Corp, JP Morgan, and Goldman Sachs. He remains one of the world's largest currency traders, routinely carrying positions of several billion U.S. dollars. Tim has taught hundreds of professional floor traders from the Board of Trade and CME to become successful off-floor electronic traders. He is a regular lecturer at some of the most prestigious graduate schools of business and finance in the United States, including MIT, Stanford, and the University of Chicago. He currently donates his time teaching basic technical analysis to 4th and 5th grade accelerated students at 59 elementary schools around the United States. This program is named Crayon Drawing. He is a regular featured speaker at the popular Traders Expos held around the world, writes a weekly column for MSN and MoneyShow.com, and gives educational webcasts for most of the exchanges around the world. He is the author of several highly regarded books, Trading with Median Lines and Mapping the Markets, featuring his own unique trading methods. His websites, www.medianline.com and www.marketgeometry.com, feature a great deal of free information regarding his trading methodology and are visited by thousands of traders from around the world on a regular basis. As always, thank you so much for making time in your schedule to be with us. And over to you, Tim.
Thank you, Pete and Cynthia. It seems like it has now been forever since I've had the pleasure of being together with you guys and presenting. And we have a great turnout today from, I don't know, 50 or more countries. Thank you all for taking time out of your schedule today. I had some business that had to be taken care of. My mom is 96, and when my mother calls and says, hey, I need you, of course I go and take care of business. But we're here. And thank you for being patient. Seems like I said, we've done one this year, so we're a few behind. We'll see if we can get caught up. I want to clarify one thing before we get started, because I know Cynthia also asked a question. She's getting lots of emails, and we'll put the link up at IB when it's available. But the fifth grader program, we are in the final week of trading, and I think at this point, we are probably going to see a sweep by people that have chosen the market geometry method, crayon drawing, that I teach. I think we're going to take all 10 places, first through 10, out of hundreds of thousands of kids around the country. So that's wonderful. And I know the stock market's been in a run-up until the beginning of this year, and it's still running up. It's not running up as fast. They can only trade stocks. They can only trade from the long side. Yet on an unannualized basis, last time I looked, which was about a week ago, they were up about 15.9% collectively, which that's pretty good. I think most hedge fund managers would like to do that. And that's with only basically, let's see, 8 weeks in the first half of the year, and that's 6 weeks so far this year. I haven't seen last week's and this week's results, so we'll see how that goes. I do have one person running away with it. They're up an amazing 42% for the year. So we'll see how they finish out. They've caught some. I wish they would send me their signals. How about that? Next year, I know we mentioned this basically. Yep. So basically, next year we're going to be doing 9th and 10th graders as well, and we were being funded by Steve Jobs privately, not Apple. And of course, Steve was a good friend, passed away. So after this year, we will not be funded by the Steve Jobs Foundation. Michael Dell has decided, another good friend, someone I knew in college, he and I were talking, he's decided that it would be nice for Dell to pick it up, but he's the one that wanted 9th and 10th graders. And that we're going to have June meetings between the scholastic organization that runs these classes for gifted students and Michael Dell's people. Okay, they're going to have to hammer out what's acceptable and what's not acceptable. I think Michael Dell wants everybody in the program to get a free laptop, so that and a Dell T-shirt and a Dell hat and Dell pencils. You know, I get that, and I understand some marketing is necessary. But even though Michael's my friend, I want and need this program to be about teaching these students how to manage their money and invest long term, whether it's a 5th grader or a 9th and 10th grader. So what computer they use is really not part of my agenda. So if they want to do it, it has to be done tastefully, and really it has to be transparent to the program. So we'll see what they come out of these meetings with. And if we can come to an agreement, we'll give out links once an agreement has reached. If they can't come out to an agreement, then basically we'll either do it at Market Geometry, or we'll go see Mr. Peter Fly and see if we can do it with IB. We'll do something. Don't worry about it. Once we have it finished, believe me, it will be, how are you, my brother? It will be listed at IB, no matter who the sponsor is. We'll give out crayon drawing links, but right now there's no link for next year yet. Meetings aren't even going to start until June, so I'd give them out if I had them. I just don't have them yet. All right, so let's get started. First of all, let me get my pointer right so I don't get spanked by Cynthia. 1 second. There we go. So I've got a pointer. Okay, good. I'm getting better. It's been a while. So we're going to do And pardon me from any of you that are a grandmaster in chess or go-moku. I play both, but I'm not a grandmaster. But I do take away from those magnificent strategy games that if you can anticipate how your opponent moves, you are much more likely to win. And the more you can anticipate, the better off you're going to be. And there are times in the market where I am 5, 6, 7, 8 moves ahead of the market in general. And so today I want to talk about that, and I want to see if I can give you a feeling for how I get there. So that's the teaching arm of Blackthorn Capital, Market Geometry. It's myself and my partner Shane Blankenship, and we've been teaching since 1987. This is the same disclaimer as you saw on the CME material, and I guess the one thing I'd highlight is there is no Holy Grail. I don't have it. If you came here looking for the Holy Grail, it doesn't exist. Okay, it's education, hard work. I wouldn't even list talent. I would tell you that there are lots of people that are not as talented as myself or, let's see, Amos Hostetler, Bill Shepard from the Chicago Mercantile Exchange, for example, people that I hold in high regard as traders, Mark Brown, another magnificent market participant. Everybody does their own thing, but there's no Holy Grail. It's not just talent. It's hard work. It's education. It's mastering yourself. That's the hardest part of the whole shot. And then one last thing. This is one person's experience, mine. Your experience may differ. You may do better than me. You may do worse than me, depending on how in tune you are with the markets, your education, where you are in your career as a trader. So results, even for me, are never guaranteed. And, of course, individual experiences are always going to vary, okay? So I'm gonna dedicate this seminar to all of you. You guys took a lot of time out of your schedule to come here, and it's going to be, we always say an hour, and of course it always goes 2.5, 3 hours. It goes what it goes. At some point, I'm sure Cynthia has to have lunch, and I'll be just out of. You won't be able to hear my voice. So thank you for coming. I'm honored. This is the same style that I used when I lectured at MIT and Stanford, which I do weekly. Please be patient while the material unfolds. At one of the universities, this might be 3 or 4 hours long. It's not going to be 3 or 4 hours long. Please keep your comments related to this material. I know I can't see them, but if I'm handing off the newest member of our family, Jordan, our little Bengal kitty, to my wife, so he can go out. And, he doesn't want to listen to this. Anyway, most of you are here to learn my methods. Just relax and enjoy the material being presented, and you can comment and ask questions afterwards. You don't have to try and teach what I'm saying. It's okay, you don't have to clarify things. The material should be self-explanatory. Please hold your questions until the presentation is over. As Cynthia said, I'm not very good at presenting and reading questions, so it's helpful for me to not see the questions, and I appreciate you doing that for me. So here we go. We want to stay 2, 4, or 6 steps ahead of the market. In this case, it's the Canadian dollar. Now, let me point out, when we planned this, it was going to be the second presentation of the year. And so we were talking about the very beginning of the year, okay? And no one wants to start their year or their month or their week on a loss, including me. Who likes to trade after a loss, right? So if I see that other traders are struggling, I'll be on high alert for some more pain, and then I'll try to spot some quality opportunities. So here's, again, it's 20-minute Canadian dollar, and you can see this is right after Christmas, coming into the end of the year. At this point, I'm actually doing this bar by bar history, so I'm doing replay to take a look at bar by bar and get caught up. I'm stalking the market, the history of the market, so that I can get ready to trade. okay? And I believe it's the 4th of January that I begin to stalk this. But I go back a number of days to just see exactly what's happening. Those of you that have been at the other seminars know that I closed my fund. My fund is for sovereign wealth, large investors, for the largest sovereign wealth funds in the world. And I closed my fund at the end of October because we had such a magnificent year. And it was triple digits. And, you know, after a year like that, it's very difficult to try and understand what to do next. What are you going to do the next year? So I started the year off with an extra bit of angst. It helped a little bit that I took some time off, but it's the 4th of January. I know it's time to start trading, but I'm not exactly sure what to do and how to do it. The way to do it is to just relax and try and understand what you're looking for. So let me tell you what I am looking for. Now, we talk about being 2 or 4 or 6 steps ahead of the market. I like repeatable patterns when I trade. So I constantly make logical assumptions. For example, if I see something we'll call A happen in the markets, and I regularly see that when I see A, it leads to B as an outcome, then that's something I'll be watching for. And then when A pops up, I'll go, well, okay, if B happens, my logic is unfolding. That's good. That makes me feel like I'm in tune with the market. And if I can stack a number of those together before I see an opportunity, then I'm coming in with confidence. I feel like I'm in step with the market. It makes it much easier to feel ready to trade. Now let's talk about the normal trader. People are most vulnerable when they are comfortable or bored. Comfortable or bored. And you can think about why you would be vulnerable if you're comfortable or vulnerable if you're bored. They're also vulnerable when they've just taken a loss. Just take a loss, you want to trade, but you don't really want to trade because you don't want another loss. You're still kind of smarting from the last one, yet you have that urge to jump back in. Especially 95% of the market in terms of participants, we're going to call them retail, less than $500,000, okay? They want to trade. They need to trade. They must trade. So even though they took a loss, they feel that urge if they're at the screen to trade. So, for example, I like to see ranges in the market that I can clearly define. Why? A range's outcome is basically 50-50. So I'm not going to use them for entering a position. I'm not a breakout trader, but a lot of the market participants are breakout traders. And that means they have poor trade location, and they don't have a very good chance. They don't have a good winning percentage. I know that people at first will get comfortable in a range, and then eventually they'll get bored. But either way, when price breaks out of a range, I know people may be vulnerable, so of course I'm going to be alert for opportunities. Similarly, if we get a very orderly market on the way up or the way down, and people have positions on, they get very comfortable. They're slow and reluctant to move their stops because they're comfortable with the whole thing. Well, you know, what's to worry about? It's just making new highs, small pullbacks, making new highs, small pullbacks, or the other side on the downside. And so if I can disrupt that, you know, I'm a whale. I trade not several $billion dollars. I trade 10 and hundreds of billions of dollars at a time. So if I can disrupt that, if I can run stops, for example, and get people off balance, I will do that. And then if the market gives me an opportunity, then I'll enter. Another thing I look for is vertical markets, markets that have just gone from comfortable markets or orderly markets or in a range, and then suddenly they blast off or they plunge. And instead of people thinking about, okay, this is easy money, where should I take my easy money off the table? Almost to a person. I've had 3 people in mentoring in the last 2 weeks, and all 3 of them did not take profit on a vertical market and ended up taking, they still made money, don't get me wrong, but they ended up getting profit stopped out. Rather than taking money at their target, because the market went vertical, I thought, oh my God, maybe it's going to go twice as far. I call it doing the happy dance. So when markets go vertical, people do the happy dance, and the logic just gets thrown out the window. That's where they're very vulnerable, and that can also lead to some wonderful opportunities. So I like to see these types of logical assumptions. I like to make them, and I like to see them work out. It'll give me confidence, and then I watch for opportunities, not entries. If I see an opportunity, then I'll decide whether or not I want to enter, and then I'll start to look for entries. Opportunities are the most important thing for me. I'm going to share one thing from one of my earliest mentors, one of the best traders I've ever seen, Amos Hofstetter, and we're going to use this today. Never try to sell at the top. That's not very wise. Sell after a reaction if there is no rally. So if price goes vertical and makes a high and then has a small pullback and doesn't make a new high after the small pullback, that's the time to look to sell. Same thing on the downside. So I'll share that from Amos, and let's see if we can get going now. So here we are. It's the 4th of January. I'm doing my homework just like you should. 20-minute bars. So this is a touch more data than I normally have on my screen, but I'm doing replay so that it's okay because I want to take a look at market structure. When it gets to the point where I'm watching live, you'll see suddenly there'll be more data on a chart. So, and if I look at this, I'm looking at the major high, major low. I'm not going to go back 2 months and grab it and draw it all the way out here. I'm just going to go back a number of days. I just want to go a few days before, right at the break on December 31st. I want to go a few days back when there was a normal market and just see what's going on. And of course, as I said, I'm going to mark out the lows. These are called advanced multi-pivot lines. I draw them from, you see the low and it closes well off of its low, and then we get a bar that closes on its high. Just throw that bar out in advance. Same thing here. We get a number of tops that are the same, then we pull back. I'm going to draw that advanced multi-pivot line on top. So we've got our bottom mark and our top marked. So I'm following along, and you can see as this bar, the second to the last bar prints, like everybody else, I say, okay, here it goes. Looks like we're blasting off. Pay attention. And of course, no, we don't. Next bar, the last bar on the chart, same size bar. This one closes on its low. We call that a mirror bar. Mirror bars are same size bars with alternating closes. Okay. They're not a change in direction. They're not, what they are is, they're a warning, and it means check your risk. Something is likely to happen. So if you can pay attention when you see these mirror bars, especially if the volatility is picking up, which it is here, you can see that the bars are getting wider relative to everything else. As the volatility picks up, if you get a set of mirror bars, it's time to pay attention. If you have a position, you want to check where your stop is. You want to check where your profit target is. If you're looking for a position, you want to be on high alert. Something's about to happen. Now, I'm not a breakout buyer, so I'm not going to buy it if it goes above, but I might wait for people to get comfortable and long and then get hurt. Then I might find an opportunity. Or if it fails here and heads lower, I might find an opportunity. That's what's going through my mind. All right, so we do break out to the top. Here's our mirror bars. And here's a large set of mirror bars right here. How about these? And you see we can't take out the lows, so we've got, I didn't draw it, but there's a nice frequency line right here where we connect all the bottoms. But what do? We pop out, we come back and retest it, can't stay in this range. And generally, after breaking out of a range, price either doubles the range or does some multiple of range's height. So double, triple, maybe even double the double. So I'll mark out where is double the range, and you can see this bar hit double the range. Now my question is it going to stop there, or are we going to triple the range? And you can do these things in advance, okay? You mark out your low, mark out your high. The moment you break out, double the range, put out that advanced multi-pivot long. Long before this happens, put this out here and say, okay, it's likely that price will double the range. If we get here, this should add to your confidence. It's like sitting across from a chess player and you say, I know this. You make a play and you say, I know this guy's going to play his king. I know what he's going to play. And if he does, that might lead to something because I think that's not the right play, but I know this guy, he's going to play a king, you watch. Okay, so the market, I know this market's going to double. So I mark it out right here when we start to break out. I'll mark it out. When it gets here, I think, okay, good. Now, I'm either going to stop and reverse here or I'm going to triple, but somewhere in here, we're going to go vertical, and we have kind of gone vertical just with this bar. But people are happy. They're long. They're getting paid to be long. They were breakout buyers, and right now they're in no trouble at all. And at some point, if they're not careful, they might be a risk. Now, I'm going to show you this. I don't know if I've ever shown this in an IB seminar, but if I have, that's fine. If I haven't, it's a great review. We use these all the time when we teach at Market Geometry, and Breakfast with a Master especially, which is a one-on-one with me in the mornings at 6 a.m. We'll look at the low, and this is the very first pullback right here. So you can see it come up and curl. And when it takes off again, you can draw this line segment just to here. And then project it forward, and that's the line of maximum excursion. And we'll use that a lot. Sometimes it's a trend barrier, so prices go up without breaking it. Sometimes it also becomes a center line if prices break below it on the downside. Okay? So let's take a look. Price, when we get here, I put out double the range. When we get here, again, I'll add the range and put out the top. And you can see price worked its way to the top. But an interesting thing happened on the way up. Price came and broke below my line of maximum excursion, the blue line. Broke below. That doesn't mean the line's not any good. Look what price does. It tests it from the backside, tests it from the backside, tests it from the backside, makes a pullback, goes all the way back, tests it from the backside, tests it, can't close above it. And now we've got multiple tops up there and a pullback, our first pullback. Hopefully you can all see that. We get up and make basically triple tops. And we're on the backside of the maximum excursion line, and then we have a pullback bar that opens on its high, closes on its low. Okay. Now we're only at the 29th of December. Okay, so we're not in heightened awareness. We're not trading here. I'm doing this bar by bar replay. Personally, I'm using NeoTicker or Ensign for my replays, and I'm drawing as each bar unfolds. I have it set on 30 times the normal speed. Okay. So after making multiple tops up here, what do? Price stalls in a new range. Now, we've gone from a nice, comfortable market that was moving up to a range. I know there are all kinds of people out there that say they know that they have this indicator or whatever. The price is going to break to the upside after it's moved, you know, in a small trend. Now it's going to break to the upside and continue. There's no way to tell. Once you are in a range, it is a 50-50 proposition. And that means that I have no edge. That's why I'm not a breakout trader. 50-50 is not good enough for me, okay? And you have poor trade location. But many people, the majority of retail traders, trade breakouts. And the little dots, little red and green dots and all that stuff, they're breakout systems. Doesn't work for me. And then how long can it stay in a range? There's lots of people that say they can tell by, you know, how far it's gone or measure this. It's all baloney. It goes as long as it goes. Some ranges are brief. I consider a range to be 4 or 5 bars. And once it reaches 4 or 5 bars, it turns into a range for me. Might be a small range. The tighter the range, the more I pay attention. But there's no way to tell when it's going to break out. It breaks out when it's going to break out. That's when you need to be patient. It'll break out. It's okay. And, of course, this one does break out, and unlike some people that have a theory about, you know, if you're in a trend, this is just a pause, and, you know, it's some better odds it's going to break to the downside. It's 50-50. This one happens to break to the downside. And, again, we're not trading. We're doing replay. 2 closes below the bottom of the upper range tells me the price is likely to retrace the entire move. I'm making a logical assumption, just like I did that price would stop at one of the multiples of its prior range. I'm making an assumption that it's going to retrace the entire move. This formation is called a chimney or a mountain, depending on the width of the formation. If it's very narrow, runs up, runs right back down, we call it a chimney. If it's broader and comes back down to its base, it's called a mountain. And the crayon, the kids in 5th grade, crayon drawers, that's their #1 go-to formation. They love mountains. They make lots of money on mountains. But you have to have a stop. If we see a mountain, I'll show you a stop, a correct market structure stop. You can't just take a test of a mountain, okay? So let's take a look again. Here's our maximum excursion on the way up. It worked very well. Now we break out to the downside, and as we do, you can see us start to plunge lower, and here's our first pullback. So we can mark a line segment that ends right here, and that's our line of maximum excursion. And if we want, we can extend it. So this is the line of maximum excursion to the downside coming out of this range. Now, again, I expect that price is going to go back all the way back below here and test its prior lows. That's my logical assumption. Note that it stopped and paused 1, 2, 3, 4, 5 bars. When it does, when it pauses, I immediately put out my advanced multi-pivot line, even though it hasn't been tested, because it may pause here for a range. Doesn't mean it's not going to go down, doesn't mean it's not going to reverse and go up. I don't know. If it turns into a range again, it's 50-50, I have no edge. But my logical assumption right now is it's going to go all the way back to the prior lows, which we've marked, so we'll see. Okay, we go into a tight range. When price plunged, I expected it to test the prior lows, and instead it's formed another tight range. Again, ranges can break out on either side, which means it's 50-50, I have no edge. And like anybody else, if you make an assumption and it's not fulfilled, after a while I begin to wonder if my logical assumption that price is going to test the prior low down here, I begin to wonder if that's flawed. There is a 50-50, there's a 50-50, so there's a 50% chance that I'm out of luck. My logical assumption is wrong. I would like my logical assumptions to be right and stack up to give me confidence when it's time to trade. Now again, we're still looking at history, traded bar by bar from Neoticker or Ensign. I think this is on Ensign, looking at the chart. And so we're still doing pre-trade analysis to try and make sure we're in the flow of things. I do this for every trade. So let's see what happens. Okay, price does work its way lower, and it tests the prior lows. So another logical assumption. Now I've got 2 logical assumptions that have worked. This line of maximum excursion worked beautifully. This one, I guess I could have taken it and copied the slope over here, but not so good, but it's okay. My logical assumptions are holding up. So again, I try to form logical expectations or assumptions based on statistics and my experience and the education my mentors, people like Amos Hostetler, Dr. Andrews, a gentleman, let's just say his name is Boom Boom, gave me from the Asian markets, the largest trader in the Asian markets in the 80s. If a market begins to meet a number of these expectations, I get much more comfortable and I feel that I'm in step with this particular market. So it's now starting to meet a number of my assumptions. I'm starting to feel a little bit better. But we're coming to the end of the year and the market's going to thin out, but that's okay. Again, it's the 4th and I'm looking at replay. I'm doing my homework. So now I take a look. We come down, we test prior lows, and the test holds. Again, that's a good thing. That's the assumption I made. The price would come back down, and this is a mountain. Price would come back down and test and hold at the prior lows. Now, this would not be a trade for the 5th graders because there's no market structure underneath there for them to hide them stops. They're going to have to wait. So they're going to have to be patient. And if they took a trade here, that would be a DQ, a disqualification. That trade would be disqualified. If they took it and it was a loser, it would count against them. If they took it and it was a winner, it would be a DQ, a disqualification. They don't get the money. I'm a tough teacher. So now I notice, as I look at it, price holds here, you know, I've got these 1, 2, 3 pushes higher. I'll just extend them into a line segment that ends right here, and that's going to be another line of maximum excursion. Price comes back to test it the 3rd time. Now I'll just extend it out there. Now, I see frequency all the time, and sometimes they drum and they don't go anywhere. This red one didn't really help me very much. But I see frequency. When I see frequency, I mark it. And when it's a maximum excursion line, I always mark it because they're very useful. And when they do get tested, they can be extremely powerful. So now I've got another maximum excursion line. It's brown. You can see I've extended it forward. I don't know what's going to happen to it. It seems to be in an odd place because we're so close to prior lows. But maybe we're going to bust through prior lows. I don't know. I really don't know. We come back down to the prior lows, and we retest it, and then so far it holds. So we know we could write down here, we did this in one of the sessions last year in gold, fact, there are buyers at this level. At least at the moment, there are significant buyers at 106.10, period. Hopefully you can all see that. Let's see what happens. This is the end of the year. After the retest, price trades a bit higher. This is the end of the year slop. And then when the real prices begin in the new year, we gap higher. We try and get all the way back to close the gap. We do get through that little minute little portion, if you want to think of the gap, that as the gap. A lot of times I'll take these days right here and just erase them and assume that the market closed on this regular sized bar and that the market opened on this regular bar. But in any case, there's a gap here one way or the other. So I'll mark the gap out. I don't know what it means. And the way I look at gaps is this. It's not the gap. It's how price reacts to the gap and whether or not there's follow-through, whether the higher the lower the gap gets respected, whether we revisit the gap. It's what the gap gives us afterwards that is really important. I do mark gaps, but I'm much more interested in what happens after the gap. So here's my maximum excursion line, my brown maximum excursion line. You can see it cuts through price nicely. Price zooms it, retests it, it comes back up. It's making higher highs, and now it's testing it from the backside. So that was nice. That worked out well. Another nice assumption. Next logical assumption that I make, price has stopped 3 times at 106.10. And it's been a pretty gentle move. People are getting very comfortable here. And now we're running higher. So they're very comfortable being long down in this area. I expect people are already accumulating long positions between 106.10 and 106.20. and they're leaving stop loss orders placed below 106.10. So with stop loss orders sitting there, the question is, has price seen its low? If it is, those stops are safe. If it isn't, and I get the opportunity, I'm going to run those stops. As a whale, that's part of what I do. I'm going to push those stop loss orders. All right. So notice that I found frequency on the top as well. I was looking at all these closes after the gap, and you know, other than one little poke up higher, basically they're all about the same. So I find the frequency, I find it pleasing. I don't know where I'm going to go with it. I connect the top. Also know that I take this high because we've sprung out of the hole and now we've stalled. The 3 bars are not making new highs, and I put out the horizontal advanced multi-pivot line. So I've got price boxed in with this low, which is the gap, and this high, which is the high of this run so far. And I want to know, this is an easy way to know market structure in advance, which way is this going to break out? Now, I'll do this a lot. And, of course, it comes from Dr. Andrews' early work in the 1920s, action-reaction lines. This is, don't blame him for this. This is my work. Maximum excursion lines and what I'm going to show you here, really my work. But it's a derivative of his work. I'll take that upper frequency line that I like so well, and I'm just going to copy its slope. Okay? Hit copy on Ensign or TradeStation or NeoTicker or Ninja or IB. IB has a copy function. You can draw these lines on IB. Copy it. I'm going to take it all the way down to the last test of this low, and it's also the lowest low by a tick or two, but same low, but it's the last low, and I'm going to copy it down here. So in essence, I've got an upper frequency line, and I've got the reflection of this frequency line. Now, don't make this mistake. This is not a channel, okay? I'm not a channel trader. This is not a channel in any way, and we're not going to use it that way. That's another great way to lose money. Curve fit a channel and try and trade off of it. That's not what we're going to do here. We want to watch how price reacts off of this frequency line and the reflection of this frequency line. Now, this is advanced stuff, guys. If you don't get it, you can watch the recording over and over. You're going to get a copy of the slides when you leave. So think about it, practice it, and by God, please take your time. If you decide you like this, take your time. Make sure you see it in the market a number of times. Then sim trade it a number of times before you even consider using these types of techniques, because there's a lot of art in drawing these lines. Now, you'll get better and better as you do more and more of it, but it's not pure, you know, ABC mathematics. But the technique itself, pretty easy to master. So again, I draw the tops off of here, and I turn that into a frequency line. Then I copy it to the low and extend it forward. Okay, so let's see what I'm going to do with that. And again, it's a second. I'm not quite ready to trade because we're coming up to the weekend, and I'm doing this actually on a Saturday afternoon or a Sunday morning before I will trade Sunday at 5 o'clock when price is open, but coming into the weekend, I'm going to probably wait for Sunday. So price trades lower from this frequency line. And believe me, I'm watching this in replay, but I'm watching it eagerly because my assumption is that this is good support and people are willing to buy in this level, okay? So let's see what happens as we come down here. We test not only the multi-pivot line from the gap, but we test this frequency reflected line, which is just this line brought to the lows. And you can see we come right to it, close on the middle or upper middle part of the bar. Test it again, close near its highs. Test it again and close on our highs. So there are buyers down here as well. So far, this reflected frequency is holding as well. And this is not curve fit. We took it from here. So another assumption is working. Now let me remind you the other part of the assumption. I believe that there are stop losses sitting right here, just piling up. And the longer we sit in this area and come back and trade and then comfortably move out, the more people are getting long and comfortable with stops right here. It only makes sense. I get it. Hopefully they're all using stops. I hope everybody that trades, every single person in the world, when they trade, uses logical stops. If they do nothing else, they have a chance to become profitable. So now price holds on the downside, and what happens? We've got the horizontal prior top marked. Price now tests the downside, it holds, we turn higher, we test the prior highs, break out, and get to the frequency line drawn from these bars. And look what happens when we get to the frequency bar. We test it and close below the halfway part of the line. We test it again with an even higher high and close on our low. So now we have a set of lines, they're frequency lines, that are showing us the probable path to price. That's what we want to use them for. So after testing the reflection of frequency on the downside, price rallies to retest the frequency line, which holds. Note that I start to keep count of the tests of these lines. 1 test, 2 tests. Now, I don't know if I put it in here. I'm sorry, I don't remember. This is also called a rolling chop because now we've got a gentle slope. We've got people testing the top side, and they test the downside. So they're buying the breakout here when we're making the highs, and they're getting stopped out probably after this low, which causes this excursion down here. Then as we break out of this top, they get long again up here, and this is poor trade location. And generally it'll wash back down as they get stopped out. If it holds, it'll turn back up, et cetera, et cetera. So I'm marking the tests. Exactly what happens. The first time price breaks and closes outside a line of frequency, including median lines, I would add a sliding parallel at its maximum excursion. Only the first sliding parallel is useful. Once it's broken, that frequency line is given away. So let's take a look. Price comes up and holds, and you can see even though it's testing the line of frequency, it's not testing with any conviction. It's immediately heading back lower. Then it starts to close back below the prior highs. Then in one fat, wide bar, it goes all the way back down to the bottom of the frequency line, spends a little time trying to hold, and then we get one quick stab below. And it's large enough, you don't have to, but we did get a close below, so I'm going to add a sliding parallel, same slope as this line, just put it out into space, and Dr. Andrews says the first time price makes an excursion outside of one of your slope lines, whether it's a median line or it's parallels. In this sense, I'm going to use it for frequency lines. The first time it makes an excursion, you put out a sliding parallel, which I've done. And as long as price stays above the sliding parallel, these sets of lines work as frequency. If we take out this sliding parallel, meaningless. At that point, you can erase them. They mean nothing, okay? So now, after coming down, one close below, then a move up. Maybe you think this is a wash. Those of you that know what a wash and a rinse is. Maybe you think this is a wash and a rinse, but it stopped right at the prior lows again, so now it's tested and retested. Now we're all the way at the top again. We make new highs. I suppose I should have put a red line here at this high so you could see that people get long at the breakouts. Now, once again, we get up to the upper frequency line. This is the original frequency line. And as we get up there, you should be asking yourself, and you probably should at this point as well, what are the positions up here? People are comfortable. People feel that there are buyers down here. Now they feel that there are buyers here. They're either accumulating longs down here. The impatient ones are buying in this area and buying in this here with poor trade location and sometimes getting stopped out. But in general, people are comfortable and they're long. We're making new highs. We just made new highs before. People are not short. So each time price breaks above prior highs, traders got long on the breakout. Those are breakout traders. So far, buying at these new highs has been a losing proposition. If you got long here, it didn't pay off very well, and you made a big enough move down that you probably stopped out, unless you're not using trades, in which case stops, in which case the market is going to give you a surprise eventually. Always use stops. Now, price is currently in an upsloping rolling chop. Okay, so I did mention about it. Price is just, which basically means they're getting long at new highs, stopped out as it retraces. Getting long at new highs, stopped out as it retraces. Getting long at new highs, we'll see what happens. Price has just broken prior highs again for the third time. And in your mind, I want you to think, what are the market positions right now? You should be keeping track of them. Again, it's coming into the weekend. I haven't traded. This is still history. I'm doing my homework. This is how I stock every trade. Now you see the true nature of a rolling chop. In an uptrending chop, smart traders try to buy just above the prior lows, so down here. Smart traders try and buy down in these levels. Even if they've not drawn to the frequency lines, they can just see it with their eyes. But the retail or breakout traders continue to enter trades on the upside with poor trade location. They buy stop. They use buy stops to enter longs as price makes new highs, and then they get stopped out near the prior low, and then the cycle continues until price breaks and holds above or below one of the frequency lines. I used to trade this in copper in the 90s. This would go on and on and on. You'd just be amazed that people would continue the same pattern, but they will, until something, an input of information takes you outside of these bars, then trade. And you can trade this very easily as a trader if you know to get out of your, as we make new highs, you should be getting out of your position. As we get down to prior lows, you should be getting long. As you get up toward prior highs, get out of your position. As we get down here, you should be getting out, be flat. I generally don't trade rolling chops on both sides. You can, and I have, but I generally tend to pick a side and trade the side. So now let's see where this leads. What are the positions? Price turns lower after the third test of the frequency line fails up here. Note that I marked the 3 tries to break above the frequency line, 1, 2, 3. And then I also marked the 3 tries to break below the frequency line, 1, 2, 3. Okay. Now we're actually going to republish this book. It's out of print, but there are a group of traders from the 30s that used to sit around in a coffee house in the Midwest and pass around their charts, and they made some really, really wonderful observations. And then they put it all together, and they would hand copy it and pass it around so that other farmers could learn how to hedge their crops. And one of the things that they noticed the first time we found that it was written down was 3 drives to the top, 3 drives to the bottom. And I noticed that they tend to come in pairs, and now at this point, it's which one of these is going to fail. In other words, is this third high going to hold, or is it going to get taken out? Is this third low going to hold or get taken out? That's going to give me quite a bit of information. So again, it's a logical assumption that whichever one breaks is going to give me information. Now, let's take a look. Price comes down and breaks and closes below the upsloping parallel. Remember, I drew in this sliding parallel right here below this frequency line? Well, we break it, then we break and close below it. I'm not going to draw another sliding parallel. It's over. Done. What were the positions? Everybody was long up here. What happened? Everybody's getting out. There's still quite a few people that have stops down here, but we'll deal with them later probably. As price breaks the multi-pivot line, even the traders that were long with good trade locations, so down in this area, see their profits disappear, and they too begin to exit their long positions. That's what causes this bar. When price made the third drive to the bottom, the frequency line and its parallel failed to hold. The blue multi-pivot line failed to contain price as well, right here. It had been tested twice, but yet there weren't buyers. Note that I marked the distance from the highest high here to the breakout of the blue multi-pivot line here. Here's another assumption. If directional energy is being expended, this is physics. Don't worry, we're not going to do any math. If directional energy is being expended, it is likely to fall at roughly twice that distance. Let me say it again. If directional energy is being expended, it's likely to fall twice as far. Now, this is the key to Sir Isaac Newton's 3 laws of motion. As above, so below. So, as above, and this would be the balance line, we're just going to double the distance. So below. So as above, so below. Okay? That's an assumption. And what I think is going to drive it, we had people that were comfortably buying here, and they've seen their profits disappear, so they are starting to sell here. Their selling is eventually likely to trigger the people that are long on these retests of this multi-pivot line. They've got stops just below this multi-pivot line. If price starts to break this multi-pivot line, they will have to sell as well. And of course, on top of that, you have breakout sellers. If it takes out this low, you'll have lots of breakout sellers, so you'll have new stop losses triggered and breakout sellers, and that should give us the ability to double this range. So that's an assumption I'm making based on physics and most importantly, and statistics, and most importantly, my experience in the market. It's a repeatable pattern that I see on a regular basis. I expect price to double this length. I can't say that again enough. Now I make another logical assumption. Price should double the distance measured from the highest high to the multi-pivot line. Each time I draw a logical assumption and its outcome matches my expectations, I gain more confidence. This is like myelination. Okay? It's pleasing to me. That means it's drawing new neural pathways in my brain. Okay, so conditions have been extremely orderly up to this point. It's likely things will now get chaotic, and some traders may experience some real pain. And this is very early in the year. Nobody wants to take a loss at the beginning of the week or the beginning of the month, but certainly the beginning of the year, pardon the language, it sucks to be your first trade to be a loser, but it's going to get chaotic because they're running stops. And those stops are triggering breakout sellers, which then triggers more stops and more breakout sellers. So this thing starts to run and gets very vertical. And as I say here, that's some good old-fashioned pain. I like to see good old-fashioned pain, not because I'm a mean guy, but because that means there's likely to be opportunities for people like me, people that have been patient, people that haven't experienced their pain, people that haven't taken a position. I've sat back in the weeds and watched. I'm willing to wait until I see what I want. As price breaks the first multi-pivot line, here, stop-loss seller orders begin to be executed. When price breaks below the second multi-pivot line, which began at the lowest prior low, this was the lowest low before, and had been tested 3 times, more stop-loss sell orders hit the market, as well as breakout sell orders, and the sell-off, something got cut off, the sell-off begins. So I want to see chaos. I crave it. I want to see pain. I want to see chaos. The orderly market has put people to sleep and made them careless. Remember, no one wants to begin their year or a month or a week with a loser. The breakout traders have been stopped out several times, so they got lots of pain. And since we keep making new highs, we kept making new highs, anyone that tried a short position either got stopped out or got out of their position at break even. The few traders that had good trade location were buying near the first multi-pivot line here. And even they were forced out of their long positions with this steep drop. No one wants a position now. They're all turned around. They don't want another loss so early in the year. Now, if I'm patient and wait until I see that I have an edge, I'll be looking for an opportunity to exploit. Notice that I don't say I'll be looking for an entry. The entry is the easiest thing in the world, guys. I don't even talk about entries. First, I want an opportunity, which means people are edgy, people are off balance, the market is in chaos, and I can find an edge. That's an opportunity. So let's see. That's some good old-fashioned pain. And once again, we should be asking ourselves, what are the positions now that we're down here? Just as we should have been asking ourselves up here, what are the positions? Well, what are the positions down here now? Do you think people are long down here? Pretty hard to be long. Let's see what my answer was. Traders are either short with poor trade location, so they sold the breakout here, or they're flat and hurting after being stopped out. And they're not really that eager to trade. But there's two things. If they trade at an institution, they're paid to trade. And those of you that are at home or in your home office, even hedge fund managers, if you're spending screen time, you feel like when you're at the screen, you should be trading. There's this pull on you to always have a position. It's just human nature. Now, let's notice one other thing before I move on. Earlier on, I said, physics tells me, as above, so below. If price makes this excursion from this high to this multi-pivot line, it should move the same amount or double the range. And where are we? We're about at double the range, aren't we? So even though price looks terrible, it can't look worse. It's absolutely vertical down. Who in their right mind would be thinking that the bottom is here? You'd have to be crazy to say, oh, the bottom is here. I know one person that can read bottoms and tops to the T. Unfortunately, he's passed away, but that was my buddy Boom Boom. But he never charted a day in his life. It was always by listening to price. So there was something in the form of what he heard that told him everything he needed to know. So let's see what happens. As I watch the next bar print, it's this bar right here, I can see and feel where this market is heading. I already now am leaning. I already now think I have an edge, folks. The path of least resistance is usually directly through the traders with poor trade location. Now, the traders with poor trade location at this point are short. The traders that either got short on a breakout of the prior low, or traders that got short after the breakout because they read this steep move down as a new trend that's about to accelerate. I wanted to see more pain and chaos, which would then set up an opportunity with an edge for me. And I see it developing now. My logical assumption, which should set up my opportunity, will come if the short positions have to cover and take their losses. Remember, my assumption that price would double the range so far has paid off. Now let's inspect this next bar. We're looking at the last two bars. Price came down and made a low and closed near its low. And the people that sold the breakout or jumped on here because they think this is the new trend, they love this close. They are darn happy. Then we get a bar that's inside. This bar opens on its low and closes, pretty much taking away all the profit that the people that had poor trade location, that pretty much their profit's gone. So they're sitting at break even, slight profit or slight loss. But in their mind, they're just focusing on this close. And they're thinking, well, okay, this is just an inside bar, it's no big deal. But in my mind, I'm playing several steps ahead. The first thing that I think is, hey, what if price was suddenly here? What would happen to these people? Who'd be hurt? Who'd still be willing to play? Where would the market likely go if price was suddenly here? I know it's not here, but that's what I'm playing in my mind. Let's see what happens. A small portion of the traders holding short positions are now starting to cover. Take a look. We make a slightly new low. You have to ask yourself, as this bar makes a low, what are the positions? Of course, they're short. It's hard to be long when you're making new lows. But look at this close. I love this close. 2 bars in a row, we've got higher closes. And this one, we made a new low. Now we're closing above the prior 2 bars. I love this close. Far too many of these people are trying to calm themselves. They're looking at the prior low, which had been support, and they're now hoping it will be resistance. In other words, this area right here, they're saying this was support, it'll be resistance. How many times have you heard people say that? You know, sometimes it's true, but if we pop above here, it's going to look like just a big wash and rinse. And the people that got short down here and the people that got rid of their longs are all going to be suffering. They're looking at the prior low, which had been support, and they are now hoping that it will be resistance. Let the chaos and the pain begin, as far as I'm concerned. And again, I'm thinking ahead, what if price is suddenly here? What's going to happen to the market? How are people going to react? We just made a new low. But I love this close. I can see it. Next bar. Price is suddenly here. Oops. Let's follow the logic. After price broke below the prior lows, stop loss orders to sell were run. Breakout sellers got short as price made new lows. Some traders thought the plunge was a new trend starting. None of the traders attempting to get short had good trade location. Price was too wild and the market was too thin. As soon as the panic selling dried up, everyone quickly realized, as they looked around at each other, that they were all short. Now, who would be getting long on these wild range bars all to the downside? Nobody. With everyone short, the path of least resistance is to the upside. And I don't know how many of you people think of it, but as price goes vertical like this, I know you're thinking about trend. Trend has been beat into you. Trend, 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 trend. It's overplayed, folks, because trends do end. And when everybody's jumped on and there's nobody left to sell and price has gone vertical, trends often end in pain, chaos, and suffering. Now, take a look. My simple projection logic worked pretty darn good. Double the range, that's pretty much double the range. I like that. So I've added up 3 or 4 logical things. I'm well ahead of the market. I know where the market's headed. I don't know if you can see it. I haven't marked it. See if you can see it. I'm going to go back one and ask you the same thing. Can you see? Ignore my blue line. Can you see where the market's going? I do. With about 80% probability, I have a pretty darn good idea of where this market's headed. And when it gets there, I think I'm likely to find an opportunity. Okay? So as this bar prints, and we close on our high, the market people that were short, they know that they just got washed. The people that were long and got out of their positions and see this close now want to be long, but they lost their positions. Someone took their positions. The people that were breakout sellers got short down here, well, they lost their money. It's even worse. Very few people at this point have made money. Okay. Here's our Happy New Year, a wide range bar higher bar. And watch what happens. Our 3 drives to the top held. Our 3 drives to the bottom did not hold. Now we've popped the bar and washed out of that. We come back now and retest this prior low and then come out of the hole. And now we're making new highs. After the wide range bar, price paused here, and anyone that wanted to get long had plenty of time. So people had plenty of time to reload the gun and get long here. And this is the area that they were getting long before, so some of them won't, but some of them still will go ahead and get long a second time. Price continues higher, bringing more longs into the market and stopping out anyone that had attempted a short. And then, of course, this bar right here, these 3 little bars, but especially this bar, when it pops, the breakout sellers can't help themselves. They must get long. It's in their genes. They just can't help it. They have not mastered themselves. They're twitching at every move like this. And so far, they're about 0 for 4 on the year, in a relatively small range. As price makes this new high, you should ask yourself, what are the positions? Just like down here, what are the positions? Anytime you get these vertical excursions, you should be asking yourself, what are the positions? Because at some point, you're going to say, what are the positions? You're actually going to know the answer, and you're going to exploit it. When we were down here and closed right here, I knew that we'd be revisiting the upside, this original frequency line. Now that we're up here, I think I can anticipate an opportunity for me, but let's watch. Okay, when price makes a new high, but then closes lower with no follow-through right here, what did Amos say? Never try to sell the top. It isn't wise. Sell after a reaction. Sell after a reaction to the downside if there's no rally. So now we've got a reaction to the downside. I see my opportunity approaching. I can see many moves ahead of most of the traders in this market. People have been hurt being long and have been hurt being shorts. Now a lot of people want to play. Better for me. Most market participants are turned around, and those that have traded are now adding up the damage in their accounts. So this first bar is the spring higher. The second bar, you can see there's not only it opens on its high and closes back below the frequency line. There's no follow through at all. And read what I say to myself. When this bar closes, I'm now 6 moves ahead of the market. I already have my opportunity framed in my mind. I have a good idea how it's going to play out. And I'm already thinking about if this opportunity prints are things like stop loss, risk reward, etc., all going to line up to make this a potential trade. I'm already that far ahead of the market. And it's only 6 o'clock in the evening on the 2nd, which is a Thursday in January. Oh, sorry, I can't do that. Here we go. Sorry. Now, I just do a simple thing. I see the opportunity flowering before me. One thing I almost always rely on when trading is finding a frequency that carries throughout price. That upsloping brown frequency line helped me define the 3 drives to the top, and the same frequency reflected showed me the bottom of the rolling chop and the 3 drives to the bottom. I'm going to begin by using that same slope and attaching it to the low price that made it in the Happy New Year wash. I'm going to attach that same frequency as this one up here. I'm going to attach it down here with the same slope. And this area seems to be a significant low where we washed everybody out. So I'll also make sure that I have the blue advanced multi-pivot line that's horizontal, and now I've got my frequency line. Now take a look. Just orient yourself. After spiking higher, price goes into a range. Now I have my logical assumptions, but there could be a problem. Price could break out of this range in either direction. It's 50-50 at this point. I don't care what I think. I don't care what I'm assuming. It's 50-50 where we're going to break out of this range. That's just the truth. You have to be honest with yourself. You have to know your statistics. You have to have the experience from trading to know. And I can tell you right now, I know what I want price to do. I know what I expect price to do. But the honest truth is, first, price is going to have to break out of this range. And depending on how it breaks out, it might blow up my entire logic tree, and I might have to scrap this whole set of ideas. And that's what I said here. The problem with logic is that you may have to scrap it if reality unfolds different than you expected. It's just the way it is. Note also, I took the frequency line here that I connected down here, and now I've put it onto the spike high because we're in a range. And I've also marked the top of the range as well as the high spike. So I've got price boxed in. We have to see how price deals with the range. And we've got our upper and lower frequency working. price breaks to the downside of the range. If I'd had that much excursion to the upside, I would now be scrapping my logic. With 2 closes below the bottom of the range, I begin to feel my opportunity is getting closer. If this opportunity unfolds and I make a trade, it will be the first trade of my year. I don't want a loss, right? I want to start out with a winner as well. I want all of my comfort food tools at hand. That means all of my favorite tools. I have lots of tools, hundreds of them. But there's 3 or 4 or 5 that I couldn't live without, okay? And I'm going to use those tools because my fund has been closed since October because it had a magnificent year last year, triple digit. I'm nervous about that. How do you follow that up? It's the beginning of the year. I don't want to take a loss at the beginning of the year. So I've got a little bit going on in my mind. I'm playing some mind games with myself. It's never a good thing, but it's the truth. The best way to deal with them is be logical. Keep your logic in front of you. That's what I'm trying to do. So you can see we broke out of the range to the downside, and we close on our low here. I've got my frequency line in here. I've got my frequency line in here. In order to trade, I'm going to need an opportunity. I'm going to need to know that people have been hurt. There's been chaos. That people really don't want to trade. That people already don't have better trade location than me. I'd rather not have anybody on board, to be honest. I'd rather be buying when nobody wants to buy and selling when nobody wants to sell. I have to have a correct stop. I have to have a good idea for a profit target. Most important, after that, I'm going to need frequency, whether it's these frequency lines or whether it's a median line that allows me entry. So all these things have to come together if my ideas come into play. And one of my close friends from the Coral Gables group, the Inner Circle for Dr. Andrews, just said, recite it just like Dr. Andrews, my brother, and that's what I'm doing. Somewhere I hope Dr. Andrews is smiling at me. So, I can draw in another slope line. Here's our spike high. Here's our curl back. Here's our first pullback. Now, that line segment right there is the line of maximum excursion. I'm going to extend it out. And I've got a new line of maximum excursion. Wish I'd done it a different color, but it is what it is. We may have broken out of the range to the downside, but what are the upper and lower frequencies? We have an upsloping brown frequency line that has been tested. But I feel I need to know the upper boundaries as well, so I look through my kitted favorite tools, and I add a downsloping maximum excursion line. So you should be able to tell now by what I'm drawing and what I'm saying where I think the opportunity is likely to form and how it's likely to unfold. If you don't worry. We're going to go through it step by step. So price comes up to the line of maximum excursion. Look at here. It really looks like it's just going to dribble down to nothing. And of course, the first rule, and this is from Dr. Andrews, is price fluctuates. And even even Amos, who really didn't know Dr. Andrews, one of his first rules was never sacrifice your position for fluctuations, saying the same thing. Price fluctuates. That's how we make our money. If price didn't fluctuate, we wouldn't be able to trade. And it looks here like price is never going to come back up to this line of maximum excursion. And of course, very quickly it does. Now, we're at my downsloping line, my line of maximum excursion, and it's a nice test. And you might even say that this is a test, but here's a beautiful test. And we close on its low. Because I want people to get involved on the short side right now at poor trade location, I want this low to be broken. Take it out. Excuse me. And you can see, okay, gone, boom, done. Price comes down, retests the upper line of maximum excursion. Now it makes a bit of a range with a slanted top. I draw out the low, and I want that line to be taken out. Now it does get taken out. So earlier, my logical assumptions were being challenged because price had a 50% chance to head higher and perhaps make a new high. Now price has reached the moment of truth on the downside. This area, pay attention, this is very important. This area has to be a higher low. It must be a higher low than this, or I can just erase these lines and move on. And this is something you should all get used to. If you start to draw lines with a purpose, you start to think logically and draw conclusions. And then the market is what the market is. The market then violates your assumptions. So if this move down takes out this low, it's important that I don't then try and salvage the idea. Well, let me draw this, let me think about this, what if it did this? I don't want to go into that mode. I want to erase the chart. And I want to get out of my chair and walk around, maybe even trade something else. But what I don't want to do is, like I said, I don't want to save the day. The day's broken, it's over, at least for this currency or commodity. Move on. I spent a lot of time and energy, but that's okay. That's just opportunity loss. Real losses, I have to make that money back. So if this has to be a higher low. If it takes out this low, my idea is now gone. All right, so my little kitty George has come over. Come here, little buddy. Price must stay and be a higher low. This must be a higher low, or I can scrap all of my logical assumptions. Piece by piece, it's all fallen into place as I saw it earlier. Will my assumptions continue to be correct? Only the market knows. I have to watch. I like that it's down here testing my maximum excursion line, but really it's the moment of truth. Now it's Friday. It's prime New York time. Let's see how and again, I'm doing this, I'll tell you when I go into live bars. I'm doing my homework. And what happens? Price actually leaves a higher low. And now you can see these are not lines of maximum excursion. I just basically eyed up. You can look at these 4 lines here. I can see the basic slope. I added them to this test to the maximum excursion line, and I added it to these lows, and of course they're parallel. And they were pretty much showing me the probable path of price. Let's see if the market believes what I drew. This has to be a higher low. Price comes up. We're at this prior low from the downside, and we're at what had been or has been. If we look at it this way, this is price moving lower. This is our nice cascade lower. Make a low, pull back, make a low, pull back, make a low. We're still pulling back. We don't know yet whether or not this is another cascade lower and we're about to end up down here, or whether we're about to take off. We just don't know yet. I know what I'm thinking, but that means nothing to the market, okay? Price stops and turns lower. Now this median line, I guess I'm not showing it here, this median line goes all the way back to the lowest low. That's that A pivot. And you can go back and recreate this. It's 20-minute Canada. It's easy for you to go back and create it. Anybody can grab 20-minute Canada. And here's my BC line on my median line, my second pivot and my third pivot. I bisect it and take it back to the first pivot. That's what gives me the slope. And you can see the slope's not very much different from what I had as the higher and lower boundaries of this cascade lower. Now as price comes up and tests and then fails and tests again and fails, and now we're in the middle between these gray lines, prices may still be cascading lower. So in order for me to think that there's an opportunity to the upside, I must see something else now. I must see new, fresh buyers. And you can imagine what that would look like. Price is near the lower parallel of my blue median line down here. It's also near the frequency line that I grabbed from up here and pulled down. But I want to see more before I commit to this opportunity. If you look carefully, price may still be cascading lower. Just look at it. This might just be another cascade that cascades lower, and that would be the end of my opportunity. My opportunity is somewhere in here, if you haven't figured that out yet. And if I do decide to place orders to go long, I want to use my favorite entry, the test and retest, because I know just how reliable it is. I want home cooking, comfort food. I'm going to use my favorite tools and nothing but my favorite tools. I'm going to be patient because it's my first trade. And again, now it's Sunday. Market's closed. It's Sunday, and I'm taking a look, getting ready to trade, or at least look for the opportunity over the weekend for Monday. Now I see the opportunity in fine detail, and I'm ready to trade. Why? This has to be a higher low. Here's the prior low. This seems to be a significant low. This has to be a higher low. It is a higher low. You can see price cascade lower, but leave even another low. So now we've got two higher lows in a row. And then we break out and get above our line that's showing us the cascade. Now we're on the other side of that, the switchback side, and then we propel to new highs. Price breaks up and out of the cascade lower, and when it takes out a prior high, that's a sign of new aggressive buyers. That's what I want to see. So I'm locked, I'm loaded, I'm ready to put in orders. Price has formed a new range, and as I've said all along, price has an equal chance of breaking out of either side of the range. The opportunity is so close, a bit of a drop in price and then a simple test and retest with some quality separation, and I would enter the market long. It's so close, but it's not here. You know, I still have people not only that send me emails after watching stuff with charts, or from our midday sessions, or from the one-on-one breakfast with the master teaching that I do during the week at 6 in the morning, before the market's open. Or even worse, from mentoring, that at this point they jump in long. Well, it's obviously making higher lows. I'm going to get long here now because I don't want to miss the opportunity. No, this is poor trade location. It's going to eat into your ability to put in a quality stop, and it's going to mess up your risk reward. We don't want to trade up here. And it's only 50-50 that this is going to break to the upside or the downside. If you trade too early, you may get washed out, or you may get taken out at break even. And generally, when people get taken out, they don't want to go back into the market in the same side in the same day. So I can see the opportunity. I know what tools I want to use. It's so close, and yet at the moment it seems like it's a long ways away. Then we break out to the downside. I take a deep breath. Thank you. Okay. What now? I have to ask myself, quality of the bottom, what do I want to see? This has to be a higher low. It is. I don't want to see this low taken out. I'd like either my brown frequency line to be working or my blue lower parallel to be working. I'm ready to put in orders, but I need to see some things. There we go. And as I'm watching and getting ready to put in orders, what happens? Turn your head to the left for me, please, about just 2 clicks, about 20 degrees. Price forms a slanted range. I'm so close, and yet, once again, now I'm in a range, and I'm at 50-50. If it breaks out to the upside, the train may have left. I may have missed my opportunity. Now, I could have traded on the frequency line if I could afford to stop, but it's not what I want. I'm using every one of my favorite tools. I want to trade off the lower parallel because the lower parallel has mathematical probability. It's not just frequency that I see by drawing. So price needs to leave a third higher low. Then, when prior tops are broken, the higher highs and higher lows will become obvious to others as well, and they will chase price. When they chase price, hopefully I will have entered, and when they chase price, they'll be moving me to profit targets. We come down and we test the blue lower parallel. I finally see what I want, a test of the lower parallel with great separation. Look at the test, look at the close, look at the low, and now look at the close. That's great separation. Better than 5 to 7 pips is my rule on a 20-minute currency trade. I'm using a 20-pip go, no go, that's how big my stop is, 20 pips. So my limit buy order is at 106.11, right at the blue median line, maybe even a tick inside, maybe 2. I don't want to miss it. 2 pips inside the lower parallel. And my stop loss order is at 105.91 because I'm using a 20 pip or tick stop based on, you can see on every one of these slides, there's a lower average to range, 55 period, and a longer one, 200. And I'm going to use the larger of the 2, and I'm pretty much looking at just about doubling them. Not quite, but just about. And I'm going to watch those on a regular basis to see what happens to volatility. So as we come down, we break the blue lower parallel, and then we pop back above, close on our high. That's great separation. So I'm willing to trade now. Before I put my orders in, here's one thing I notice. Well, we leave this tail down here, so I put in, as I said earlier, a sliding parallel, and if it gets broken, of course, then the frequency is dead. So I put in my sliding parallel. If I was cheap, I could try and trade off that sliding parallel, but I don't need to be. Look, I can afford to have my stop all the way underneath this C pivot low. So trading here and trading here are the same trade. They're both going to use a 20 pip stop. So it's much more likely the price will react with the blue lower parallel, which has mathematical probability, than that it'll come down to the sliding parallel. So I'm going to actually be 2 pips inside of this lower parallel because I can afford it and I want to get filled if price gets down here. I've waited patiently. It's Monday. I'm willing to trade. Now, I get up at 3 o'clock in the morning to trade. It's 3 o'clock in the morning. So I'm coming into the office. Those of you that have been at private seminars or been at the seminars here before know that I have a brokerage firm and we nickname them. I'm not going to tell you their real name because then people will know it's me trading through them, but we call them the Graybeards. And so the Graybeards have been watching my drawing. I'm just getting up. I'm washing my face, getting some green tea, coming into the office. It's time to trade. I've got my orders in. And take a look. A couple bars after I walk into the office, I've got my order in, I've got my stop in. I get filled. In fact, we have 2 bars. Now, we have to buy lots. You know, not 10 contracts, not 1,000 contracts, not 10,000 contracts. We have to buy tens of billions of dollars. So it takes some time, and luckily we get some time. The market's a little bit sleepy, and there are people that are willing to sell at this area. Frankly, we call our buddy at the largest Canadian bank that has a U.S. presence and get a price on, we call it large, and we give him the entire business. He'd rather know what I'm going to do rather than I pass it around the market and he has to chase. He'd rather have it all in his hands. So I've got that relationship. The Graybeards call. He makes them a price. They get in where they need to get in. Price sits here for a moment, so maybe he's starting to cover, and then you can see it pop out. So every assumption I made, every step I saw as the high was being made earlier, all the way back there, before we made that poke high, one by one as I envisioned it, they all came true. My limit buy order was filled, and then price closes on its high with great separation. So far, that's a great sign. So all of my assumptions came true, 6, 7, 8 of them. I'm ahead of the market. I'm thinking about this opportunity well before we're making a spike high that's going to set up the sell-off to give me the opportunity. Now I'm in the market. It closes on its high. So far, I'm starting out good. Let's see what we get. Okay, we've got this line of maximum excursion that's been tested, and it's hanging in front of us. And some people would say, are you sure you want to go along with that line right in front of you? Well, yeah, I do. It's okay. Now, we didn't talk about one thing. Let's talk about the one thing. One is, do you want to get along with that line of maximum excursion right in front of you? I think price has been in such a narrow range for so long, there's a lot of energy. There's a lot of people trying to make their first winning trade of the year. There's a lot of reasons, if price breaks out, for it to continue to run. So I'm more than willing to take this trade. I think this line of maximum excursion, though it's been tested, will break. But if it doesn't, look, the one thing you have to face as a trader over and over again is that no matter how good you are, there will be losses. And if you can't deal with that, you are going to be a losing trader. Not every trade is going to be a winner. My winning percentage is about 66%. But even at that level, which is really high, and you know, don't go, oh my God, I'm only at 47%. 47% if you use good risk reward. You have very nice winning percentages. That's an overrated statistic. But even at my winning percentage, that means a third of my trades are wrong. So I can be wrong on a regular, and I am wrong on a regular basis, okay? So let's see what the market brings us. We do go to the line of maximum excursion, right where my cursor is, and we do stop. So how do I feel about that? Now is when patience and believing in your lines pays off. Price has some obstacles to overcome. Now, target. You need your target for risk reward. I never trade with less than 3-to-1 risk reward. Simple. And that comes directly from Amos. If you trade at 3-to-1 or better, you're going to cover up so many mistakes. And remember, every time you trade make a winner, you now have the ability to have 2 losers and still be trading with the market's money. My minimum profit is not this blue median line that you see in front of you, but the upper parallel. I want it to go in parlance that we said before, blue to blue. But I'm not going to put an order there because I want to see, I have yet to see anything other than an orderly market. I want to see this market explode. I want to see this market explode. So I'll pay attention as we get close to the upper parallel, and if need be, if it seems like it's slowing down, I'll just put in my order, okay? But I'm going to also, the other part of this, the reason why I'm allowing myself that privilege is I'm going to be boxing in profits. I'm going to have stop profit orders in all the way on purpose. So let's see if I can work both sides. First of all, let's see if I get stopped out here. But if I don't, we've got this problem in front of us, we've got the median line in front of us, and we'd also like price to go vertical. So let's see what we get. Okay, we do break above the maximum excursion line. Great. That's wonderful. Of course I like that. So one of my obstacles is now out of the way. I'm still not at break even. I've only really got, it seems like a lot, but I've really only got 35 pips of this at the most, maybe less. So patience, don't get excited, stick with your plan. 2 closes above the line of maximum excursion, and price is starting to make higher highs and higher lows. So at this point, now that we're making higher highs and higher lows, and now higher highs, we've taken out these highs as well. At this point, a lot of the market is starting to understand, oh my, think about this. This thing is making higher lows and higher highs. I got to find a way in. So now people are going to try and find their way in, and as they do, of course, they're going to bring price to higher levels. Higher levels means I've got profit in my position, more and more profit, okay? And what do? We run all the way to the median line. We zoom the median line. At this point, even though it's 55 points, 56 points, 57, 50, 60 points maybe, think about it. We had a 20 pip stop. If it's pretty close to 60 points, which is 106, 66, 106.70, right in that area, we've got our 3-to-1. Now, I don't want to take my position off here. You can if you want to. I don't. I think this thing is ready for a ride, but if you want to, you could. But most importantly, if you have a smaller account, $500,000 or less, you need to be at break even now. You cannot let this become a loss. You've met the minimum objective, which is to go from the lower parallel to the median line, and that has an 80% probability. It has an 80% probability to get to the median line. It's now in the median line and past the median line. So now we expect a retest. Let's see how price deals with this vertical move. And you can see we get our retest, and then we get lower highs. I draw in a sliding parallel on the inside, not because I'm trying to draw a line in the sand. I'm just curious about the frequency. And I want to know how price reacts to it. You can see it doesn't even pause. Then it forms a slanted range. We have a 50-50 chance here. As it forms a slanted range, we have a prior low here. You might consider moving your profit stop up. Now, we were using 20 pips for our go, no go. We're going to use 15 pips. Take a look at our ATR. Just a little bit bigger than our ATR. We're going to use 15 pips below a prior low as the box-in profits. So at this point, we're not boxing in much. We're only boxing in about 9 pips. And now we'll see what the market does. The market seems to have broken out of this range to the upside, but we'll see. It's important that you, at some point, know how to go to break even and then how to start boxing in profits. If you do that, then you can have grander, if you will, targets. Now, we're not going to sell parts off because that's going to lower your risk return, your risk reward, okay? As Amos said, do not sacrifice your position for fluctuations. These are mere fluctuations. We want people that are long to get bored and start to sell off because their profit is eroding. We want that to happen. It's okay with us because they'll get interested again if it makes new highs, and they'll have to buy at new highs, and that'll push our position higher. So let's see what happens. Now you can see, it's a bit later, this area holds, price in a nice, comfortable fashion, works its way higher, comes through the median line, tests the prior highs, closing on its high. Quality of money management and execution, sticking to the plan. That's the key now. The hard part for most people is to see the opportunity. I'm not talking about the entry, the opportunity. Do I want to go long? Do I want to go short? But long before that spike happened before, do I want to go long or do I want to get short? Can you see the opportunity? If you can see the opportunity, the last thing you have to envision is the entry that's low on your level. After all the logic and patience, it's come down to discipline, self-discipline, and the plan. Note that as price breaks above the prior high, I move my stop profit even higher, so I go underneath this range, the slanted range. I take the low, extend it out, and when we break above the prior high here, I'm boxing in profits. I move my stop up even higher. I mean, it's not a huge amount of money. We've got a lot of money on the table, but we're going to move it up as we can. I'm just going to keep boxing in profits. The key now, our job now, is to patiently follow the plan, execute, box in profits, be patient. Let price fluctuate. It's okay. Okay, I box in profits again. You can see price comes down below the median line, can't stay below it, then makes new highs. I mark the double bottoms down here with a blue advanced multi-pivot line. When we take out the highs, I box in profit down here. Now I've got about 44 pips locked in. Okay, that's 2 to 1. It's not going to be a huge day, but it's a nice profit. I'd also note that this has still been a nice orderly move. I don't see any excitement. I don't see anybody accelerating to the upside or downside. It's just everybody's nice and comfortable. I'm not going to show you my tell when I push a market or wash a market, but I'm not above giving a market a kick when it needs to wake up. Price is just beginning to accelerate right before the upper parallel. Can you see price catch fire here? We left the low just above the median line now, and now price these highs, then these lows. So I've got a box, but then we immediately accelerate out of the box, and price catches fire. Price is just beginning to accelerate right before the upper parallel. Since I have a profit stop trailing under price, I'll be slow to take profits, giving price a chance to blossom or flower. In other words, I'm boxing in profits. I know I'm making getting close to the upper parallel, but I'm willing to let it run because it's just catching fire now. I want to see if price truly does accelerate now. And this is where my profit target would have been if I had just thrown a profit target in. But once we break above prior highs, I can box this in. Now I'm risking the difference between 106.82 and 107.25. I'm willing to risk, let's say, those 45 or 46 pips of profit to see what happens as it gets to the upper parallel. And sure enough, look what it does. It zooms to the upper parallel with a very wide range bar. So I box in my profits. I relax, take a breath. I mark where the median line is or the upper parallel. And I'll just see if I can box in more profits. That's my job now, to manage this trade. And you can see we zoom higher. We come back and retest this median line. And we're in the range. So patience and discipline. You must exhibit rock-solid money management. You know, in the hedge fund world, I'm known as other hedge fund guys come and pay me to teach them money management because of my time with Amos. I'm surgical in money management. You must know your market structure and how to use it to protect profits while giving price enough freedom to move higher. I don't want to move my profit stop too close. Notice how long it took for me to feel comfortable to move my profit stop higher. I waited a long time. Now we break out to the upside, and right in front of us is the second warning line. I've now taken out not only the parallel, here's my zoom of the parallel. Now I've dealt with the first warning line. I've almost reached the second parallel line. I put out a red horizontal line. I pull back to the first warning line. And then when we break out here, I finally move my profit stop from here all the way to here. I'm long at 106.11. And now the worst that happens to me is I get stopped out at 107.80. That's 170 pips. Any way you cut it. Yeah, I could take my money at 108 whatever, but I don't know that it's done yet. At this point, I'm good at 107.80. Money management, self-discipline. Well, what does happen? We zoom the second warning line now, and we get a nice little pullback. And when we zoom, I'm going to box in more profits. The more vertical we go, the more aggressive I'm going to be with my profit target, my profit stops, because they are likely to come back. Okay. Notice that it's already Thursday, so I've been long the entire week. I'm very patient. Just continue to do your job. Box profits when market structure is broken to the upside. If your profit target gets hit, that's great. Don't feel bad. That's what this is for. That means, you know, hey, you got out at now, your profit stop is at 108.10. You'd have 200 ticks in this. That's $2,000 a contract. That's great. If it continues, that's great too. But your job is to just continue and understand how to move your profit targets, your profit stops, and how to have a target. When to just walk away, okay? And if you decided, you know what, the first warning line was fine, that's okay. Or the second warning line is fine, that's okay. There's nothing wrong with that. You have to have your own plan. Your plan maybe will look different than mine. So let's see. We've now zoomed the second warning line. Again, we took out the prior high when we were up here, and now we're accelerating vertically. It's Friday. It's prime time Monday. Sorry, prime time Friday, and we accelerate vertically. Take a look, past the prior highs, past the second warning line. The third warning line's in front of us. I'd love to box in more profits. Give me the opportunity. I've got a box that's broken out. Now I need to find new highs so I can find new lows and then box in more. You can see my stop is still down at 108.10. And so far I don't have a new box. And look how vertical it is. Can you feel it? People reaching and stretching. Got to have it, must have it. We zoom the third warning line, and price is absolutely vertical. I cannot find a place to lock in profits. There's no place for me to put a profit stop. I'm still at 108.10. We're at 109.25. I'd like to lock in profits. It's Friday. It's my first trade of the year. To be honest with you, I don't really want a position over the weekend. So I'd like a comfortable profit stop, and I'd like to know what a good opportunity to get out would be. I don't really have one, so I call the gentleman that I gave the company to, the Graybeards. He and I have been together since 1980. We have a nice long talk about the market. And I tell him, you know, it's Friday. I don't want this position over the weekend, okay? But it's gone vertical, and my profit stuff, and they can see, you know, if you're looking at your screens, they have an execution screen, like a set of execution screens, 2 of them. They actually use IB. And then on top of that, they have mounted a 55-inch monitor, which actually is an image of my drawings, whatever I'm working on. So in this case, it would be Ensign in 20-minute Canada, and they can see all my drawings. And they can write on my drawings so I can see what they're thinking. If I don't pick up the phone just doesn't ring, it just blinks. So I talked to Michael, and we're trying to come up with something that makes me feel comfortable. I'm protected down here in any case, but I'd like to be protected up in here. And after talking to him, I put down the phone. Let me read this before I get to here. With no place to box in profits and quite a lot of profits sitting unprotected because the market did finally go vertical, I sought the friend I hired to run my brokerage firm. He's been with me since 1980. He listened to me. He hung up the phone, and he went to business. Went and took care of business. Michael and the Graybeards, this is what they wrote on my chart as this bar was up there. Pigs get slaughtered. You're out at 109.26 average. You're out. They just took me out. After having the discussion and me telling them, look, I can't put in a profit stop. I don't want this on Friday, after Friday over the weekend. Well, they just did the obvious, which was, look, boss, we're just taking you out. It doesn't make sense. The risk reward now is inverted. Think about it this way. I've got 200 pips locked in, and where are we relative to price? So I'm locked in at 108.10. I'm at 109. It was as high as 109.45. Now we're at 109.25. So we're risking 125 pips, which is all of this. And we're bagging in 200 points. So it's 1-to-1 at this point, maybe to touch better. It doesn't make sense. We want to, and that's called, that's when our risk reward gets out of balance. We want our risk reward to be in balance. Right now it's not in balance, and I'm trying to find a place to put a profit stop, but I cannot. So the Graybeards do the obvious for me. Just, you know what, it's time to sell. You don't want it over the weekend, so it's time to sell. So they sell for me and get me out at 109.26, and then watch what happens the rest of the day. We never come back to our highs. We just dribble off the rest of the day, and that's the close. Now, I typed into them after a few bars, okay, I got long at 106.11, I risked 20 pips. I'm out at 109.26, net 315 pips, which equals $3,150 per $100,000. That gives me a risk reward of 16-to-1. My minimum is 3-to-1. That's pretty darn good for a first trade, for any trade. Launch on me, guys, take it off. So they made sure that they had bought and sold equal amounts. They made sure that the P&L was correct. I did the same thing. I did exactly the same thing. I'm done for the day. They go and get a nice lunch on me. And believe me, they eat pretty darn well. There's 8 of them plus Michael. Well, later on you'll see in the year it becomes 9 plus Michael, but right now it's 8 and Michael. So there's always enough people to cover each of the 3 time zones. So, Cynthia, I know you've been patient. Let me just double check, but I think. So let me just recap. This is where the change began. This is how I began my trading year in 2014. After being patient, long here, stop at 105.91, and you can see me box in the profits. Boxing. When it goes vertical and I can't box, and I have a talk with the Graybeards, Michael knows me well enough, he just takes me out. I send everybody to lunch, and even through Sunday, we're looking pretty good. And I think that's good, Cynthia. Now, before you do your thing, I got to remind everybody, I guarantee you, Cynthia's going to open up chat in a minute so that I can answer questions. But before she does that, there's going to be a poll. When we get to don't ask me questions privately. Hang on, it's going to open up in the panel, and you'll be able to ask, and everybody will be able to read them. Just hang on a second. There's going to be a poll, and when you see the poll, there's going to be a second section. So I think it's number 2, and it allows you to write something in. This is not for me. This is for Cynthia, and she's not going to ask you to do this, but I will. Write in Cynthia or more webinars, something like that, because that tells Mr. Peterfly and all the rest of management, Cynthia's doing a great job. There you go. Number 2, type in seminars or Cynthia. It tells them, hey, we need more. So there's your poll.
Okay, and I did open it up because I want to conserve some time, everyone, but please make your selections quickly here because the poll is only going to be open for about a half a minute here. So notice that two of the questions are multiple choice as well. And once you do make your selections, make sure you click that submit button in the lower right-hand corner of the box. That actually allows me to compile those results. Now, also, I want to let everyone know I have opened up the chat panel. So as soon as you submit that poll, you can actually use the X in the upper right-hand corner of the screen. That will close the polling panel down. Now, the chat has been reopened, so Tim can view all of your questions, and just make sure that you'll notice the send to box now has all participants. I'm going to ask that you send it to all participants so that we can all benefit from those questions. Okay, everyone, poll has ended, and thank you very much for your participation. And now, looks like we've got some questions in there. Now, Tim, are you able to see the questions
Yep.
that came in previously? Okay.
Well, I got some.
Any that I've seen that I know that you haven't, I'm going to go ahead and enter them into the chat panel. So
okay. All right.
Back to you.
If you had to leave the recording, you're going to be able to see your answer when you come back and read it again. If you're not here, hopefully you'll come back and watch the recording. I would suggest all of you come back and watch the recordings. You're going to get a copy. As you leave, you're going to get a copy of the slides so you can draw and mark them up yourself, and then go back and watch the recording and see if it matches what I was saying. Let's see. How many bars do you have on your blank chart on a weekly, daily, 4-hour, an hour, 20 minutes? I just like to have lots of space on the right. It reminds me that I'm trading forward, okay? I'm thinking ahead. Ari wants to know, I'd sell some and keep rest. I never take profits at multiple places. It lowers your risk reward. Similarly, I don't add, okay? That also lowers your risk reward. I plan out my trade. I keep it simple. How do you handle economic data releases and news? I don't ever listen to the news. If I think there's an economic data release, you guys may know that I have a PhD in economics as well as math and physics. I get the economics, I understand that, but you don't have an edge any longer because everybody gets the economics at the same time. So if it's like, for example, a Fed announcement where they might change rates or something, I might have on my desk, 8 o'clock or 10 o'clock, but I don't even put down what it is. And if I have a position on that has profit with a profit stop on it, I don't even care. If I'm thinking about putting a position on, I might wait until that time is over, let the market come back to normal conditions, and then trade. What if break of swing does not have a follow-through but has a close? Does it consider a breakout? Breakouts are breakouts. It needs to have a follow-through, period. Otherwise, you can't box in. Do I still use Fibonacci extensions or retracements in your trading? Heiko must have seen stuff from the past or read some of my articles. I use them, but not in the way that you would. I tend to, in fact, my friend Joe DiNapoli, very close friend, even he does the same thing I do. I will often, no offense to all of you, I'll often mark the 382, and then when the stops build up underneath the 382, I'll run the stops. Same thing at the 1.27. Okay, so I'll use them, but probably not in the way that you do. That was mind-boggling good time. I appreciate it, Thomas. How are you? That's what we have for today. Am I missing them, Cynthia? Or are we?
Actually,
maybe everybody's tired.
No, actually, they're all coming in to me. All participants didn't activate, so I just sent everyone. Now, everyone, if you do go in, all participants, I have one box unchecked. So now,
okay, I'll just be patient.
And I'll start sending you some more.
Okay, thank you, Debbie. I appreciate it, and thank you for taking time to come. I hope it was interesting. It really helps me when Cynthia takes chat off, so I don't actually have to look. Andrew, as in Dr. Andrews. I assume that this applies to stocks as well. This works with anything, as Dr. Andrews would say, anything that fluctuates, including weather. You can chart the weather. And so, you know, stocks, any time frame, anything you want to do. And now I'm starting to see some friends as well. Are you going through this process? How many markets can you comfortably follow? Richard, that's a great question. When I portfolio trade, I look at the 27 things, but you know, I'm only actually have 3 or 4 things that are doing anything interesting. When I intraday trade, which is what I consider this, even though it took 5 days to unfold, I only follow 3 to 5 things, and the moment I have an opportunity spotted, all my attention goes to that. So when I'm just looking, I'll be looking at 3 to 5 things. But once I hone in on the market and I say, okay, this is the one that I think is going to give me an opportunity, I will follow that market in just that market until either the opportunity plays out and I have a position, and then I'm not going to take another position, so I'll just manage that trade, or if the opportunity does not play out, then I'll move to the other markets again and start looking again, okay? Gina, how are you, darling? Myelinate 1, you got it. And Gina's one of my sweet students. Are you going through this process? No, we already did that. Kashal, what if the break is free? Nope, we did that one. Andrew, yeah, we did that one. What does run the stops mean? Well, Andrew, if we have a multi-pivot line, a horizontal line, or you might call it a trend line, and everybody sees that it's holding, 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 they might get long near that trend line, and then they'll put their stops 5 or 6 or 10 pips underneath that line, okay? Now, I'm a whale. I trade billions of dollars at a time, sometimes tens or hundreds of billions of dollars. So if I want to get, let's say that the stops are underneath, if I want to get cheap dollars against Canada, I will push the market lower, run all the stops that are sitting there. If you've left your stop there, I'll run your stop, but I'll have buy orders, or I'll be in with 2 hands buying while your stops are being run, and I'll be getting them 10 or 20 pips cheaper. Irwin says, great webinar. I have a question on grape separation. Sometimes the bar with grape separation can be interpreted both ways. As of when do you define the closure to be grape separation? One could sometimes argue that, for example, when closing halfway the bar, also the opposite view is defendable. Oh, okay. Well, I would say it this way, Irwin. If it's moving in an uptrend, if we've made a low and now we're seeing it close from the low to the upside, I'm measuring from the low to the upside. And it's not that I want it to be in the upper half or lower half. I need it to be at least 5 to 7 pips off the low on a 20-minute chart. It's a good question, though. When I'm paying attention to separation, I've already got my opportunity. I'm already leaning in one direction, so that's why I'm only looking at that side. Boy, they're coming in fast now, Cynthia. I can't even scroll that fast. All right. Thank you very much, Albert. I appreciate the good words. Let's see. Do I trade options? No. Well, at one point I ran the largest options firm in the world, at least at that time. It was called Chicago Research and Trading, and we owned it. And the number one thing I learned was that I should do what I do really well, and I should let my options traders do what they do really well. I'm very good at one-dimensional risk, meaning long or short. You know, things like beta, alpha, or volatility, et cetera. It just adds extra complexity to me. I do very, very well at one-dimensional risk, and so I stick with what I do best. You can certainly use options in this method, John. One of the largest stock brokerage firms in the world, its president actually is one of my students, and he always trades using options. We just simply we teach him to couch his positions based on these methods. So when price gets to the moment of truth, rather than getting long, he'll take an option, or maybe he'll do a spread. It's greatly improved his trading. This is best so far. Thank you. Appreciate it. Albert, and you have a good year too. Let's see. What percentage of available money would you commit if you're trading just one position? Let me put it to you this way, Debbie. I never risk more than 1.6% of my capital on my stop. And you can go backwards from there. Okay? The people that are on, I also offer a class called Evening with the Master, which is about portfolio trading. And there we do equivalent risk, and we also do how to cut up margin and what amount of margin would you want to commit. But the simple way to look at it is that on any particular position, I never risk more than 1.6%. Now, I trade basically unleveraged. So, but even unleveraged, my positions are huge. So, hi, Gerald, how are you? All right, so I didn't know. Gerald says a lot of great information in a short time. It seems like it was the first presentation this year, so I was a little nervous. I didn't know how you guys would view it, so that's good. Thanks so much, Professor. I appreciate it, Todd. This one is for you and Cynthia. When might you cover some of these 33% losses? Well, let me just explain this. Everybody, well, not everybody. I get these questions every once in a while. Let me tell you, when my son takes batting practice, and he takes batting practice from somebody that was in the majors for 2 years, and he's a wonderful teacher, they don't spend any time on bad hits. They practice their technique, and they work on better and better hitting, okay? When I work out at CrossFit, and I work one-on-one with CCT Joey Powell, at one point a battle commander for every single special ops or black ops group in the United States military, and he's actually going to do a seminar with us. When he works out with me and shows me how to do it, he never says, okay, yeah, here's how to fail a lift. Okay, my losses are very simple. If you saw them, I couldn't do a seminar on them. They're too boring. They're generally within 3 bars, and basically when I tell you, hey, it's the moment of truth, it closed with separation, I'm going to put my buy order in. What generally happens is I get long, and next bar I get stopped out. There's nothing to it. I very seldom get dragged into a range. Pretty much, if I'm wrong, I get shot right away. So there's really nothing to be learned there. And I also would recommend, while you can go back and take a look at your losses and see if there's anything particular that you're doing over and over, that for the most part, if you're starting to be consistently profitable, I wouldn't spend too much time on my losses. I would spend a lot of time recovering balance and relaxing and clearing my mind for the next trade. Thank you, John. I appreciate it. A mellifluous voice. Wow, I haven't heard that in a while. Hi, David. Do you always use 20-minute charts? No. Is there any place, do you think, for volume charts? Volume charts sometimes on S&Ps, for example. Volume charts on currency futures are, and even cash foreign exchange are not interesting to me, because while many people think volume is meaningful, it's very manipulated. I know how to manipulate it. I often do manipulate it. And as a Reg 47 holder, it means I don't have to always report what I'm doing. So I'm not particularly drawn into volume charts. It's sometimes useful on the E-mini S&Ps. There's so much going on, it does clear out a lot of the noise. But I do like tick charts a lot, David, which takes out time in the equation. I use 20 minutes a lot. I'll sometimes look at 60s, but I'm more likely to use 20s or 240s for intraday trading. And then for longer terms, I use dailies, weeklies, monthlies. Oh my gosh. Here's somebody that actually has met Amos. Wow. It's Shearson's. Okay, and Short Hills back in 1976. Now, Richard, you know, he passed away a couple years later, but that's great. I mean, there are very few of us around that had the honor to meet, and I spent 4 years, you know, as a young teenager. He agreed to allow me, he gave me a desk, he allowed to, when I could, fly in, come, sit. I'd go get him coffee, I'd go get him I'd sharpen his pencils, I'd help him chart, and every day I'd hope I could pick up a nugget of knowledge, to be honest. And as the relationship went on, it became much more enlightening, but, you know, like anything. Do you always, oh, I did that 20 minutes, let's see. How do you project the maximum line of excursion in an uptrend? Well, you start at the first poke higher, then you wait for that pullback, that first pullback, and then when it comes back up and leaves the high, then you project it off of that first pullback high. I've got stock which drops some 30%. They say bear market. I don't know. Do I need to wait if price goes above 38.2? I don't care. I'm sorry, I don't care about 38.2 to consider any long frequencies, or I don't need to wait for if I got frequency near the lows and median line sets and nice stops, of course. Well, if you do have nice stops again, and you do have a median line set with frequency, and you're looking to buy, if you think you have an opportunity, you've got a good stop, that's what trading is for. I would forget about the 38.2. I don't care about that. That's meaningless to me. So I assume you mean you're following stocks which have dropped 30%. Now, in terms of bear or bull market, it's meaningless to me. Those long-term trends, that's fine, but you're not trading the long-term trend, and you're also trading a stock, not an indice. So I would just look carefully at what you're trading in that time frame that you are trading. Don't go back and forth between multiple time frames. If you've got frequency, you've got an opportunity, and you've got quality stops underneath structure, that's all you need. You don't need to know anything about fits. Oh, you're going to break my heart. Yeah, I had Maybean's daily pitchfork looking like getting reaction at upper median lines for possible shorts. What are your thoughts since we are entering a seasonal period that could get weather volatility usually to the upside if it happens? Well, Ed, this is the first year that I can remember that I probably missed a long. I don't know, the last 6 or 7 years, I got one, if not two, nice, beautiful long trades between the middle of November and now. And so far, I mean, partly we have not done the natural gas trade. I don't know if we'll do it here, but I had a huge natural gas trade, 5th largest trader in my career. And but I used more leverage than I had intended to. I sent the wrong leverage sheet to the graybeard, so I make mistakes. When I make a mistake, I take 30 days off. I don't trade or chart for 30 days. So I have been in the penalty box. My evening with the master group nailed the pullback in beans to the tick. Upside, yeah, it could stop here. It might stop here. There is an area where you should be looking for the possibility for shorts. But remember what Amos said. Never try to sell at the top. That's not wise. Wait for a reaction, and then if it doesn't make a new high, then look for shorts. So I call that selling on a shoulder. And I don't mean head and shoulders. I don't know anything about shampoo, but don't try to sell at the top. Sell after a reaction if there's not a new rally to new highs. So that's what I would say. And I'm kind of bummed that I didn't get long beans. So, but hey, that's life. Irwin says, how can I detect a large trader entering extra the markets? They probably leave some footprints that are valuable. Yeah, we call them whale tracks. Yep. Any hints? The smartest way is to go through markets that you are familiar with and mark these washes and rinses at major highs or lows. Watch what happens after spikes, and you're looking for things that are repetitious. Generally, those are whale tracks. And we teach that at Market Geometry, both in the midday session and in the breakfast session. The midday session, Shane and I teach together at 11 o'clock Arizona, and then the more advanced traders or traders that want to know more take a separate class with me at 6 a.m. Arizona time before the markets open. And we talk a lot about what whales do, how they do it, how they manipulate a market, and how you don't have to be a whale to trade like a whale. You can trade right along with them because, as I said, you can be 4 or 5 steps ahead of the market. You can see this guy setting up the market, and the moment you see him pull the trigger, you can jump right in and go with him. Let's see. Stefan, how are you? Can you outline how we might manage to trade differently? Well, you're plankton and I'm a whale. I get that. Well, one thing, Stefan, is this. Remember I told you when you got that first breakout, you need to be at break even, okay? Sometimes my stops are further back than yours would be. I do try to show trades in the fashion that you should trade them, not necessarily the way I trade them. I know that, you know, my stops are wider and your stops should be smaller. Second thing, if I had a smaller account, you know, if you feel like you are plankton, if you were able to get long at that lower parallel and you were better than 3-to-1 and you were at the upper parallel, that has an 80% probability. What's wrong with taking your profit there? That was a lot of money. So you don't have to ride the whole way. Take some money, get out. Maybe you want to wait for another opportunity. Maybe you want to move to a different thing. But you know, you don't have to hold these positions overnight. On 20 minutes, you can find lots of trades that give you 3-to-1 at logical profit areas. Take your money, walk away. And then you can slowly build your account, slowly build your confidence. That's a great way to trade. This one, I let it run, but you certainly don't have to. There were several places there that were logical profit areas that it would be great if you just took your profit. Oh, I got a kitty standing in front of me. I can't see the screen. One second. Come here, Jordan. Let's see. Oh, okay. Ed says, please let me know on their book reprint of Midwest Farmers. I was never able to find anything in that book. You won't be able to find that book. There was a gentleman, a friend of mine, that was going to print it, and I have a hard copy first run that I edited for him, and unfortunately he went out of business. He was in the UK, and he had 5 great books he was going to reprint, and I just think it's great. Nobody else is going to reprint them. I'll reprint them. So don't worry. When we reprint them, we'll, with Cynthia's permission, they'll be inexpensive. We just don't want the knowledge to die. We'll let you know. And what we're thinking of doing with that, and we're also going to do an Amos pamphlet would be the right word. We'll probably give all that money to charity. We may have to use it to support the 5th grader group. I don't know. At your entry in this trade, if you did not see price close above the open, would you still feel confident to place the buy order? It's not that it closes above the open, it's that it closes with separation. If I get my 5 to 7 ticks above separation, okay, when it tests the median line, the lower parallel, I need it to close with separation, 5 to 7 pips, or I'll wait for another bar. I'll wait till I do get separation. Once I get separation, then I'll put my order in, okay? It's not the relationship of open and close, okay? Stocks, yep, stocks, anything, any time frame. Okay, thank you, Jack. A range has inside swing breakouts. It's confusing to judge them. Okay. Well, you need to mark up charts and think of the statistics and the possibilities. You heard me say, for example, here's a range. It's got a 50% probability. When it breaks out to the upside, you now have support underneath the bottom of that range, for example. Just you need to mark more charts and think about every single, you're saying inside swing breakouts. You need to think about each of those opportunities, okay, and follow them through on a regular basis and do more work. Amos says, I'm looking at some of the stuff I wrote down from Amos. Don't sacrifice your position for fluctuations. It's the same thing. You don't want to just twitch just because the market has twitched a little bit inside of the big picture. Let's see. Hey, Johnny, how are you? When you say under leverage, does that mean the margin requirements of the contract are much more? I'm much less, actually. Often, Johnny, I'm literally trading dollar for dollar. So if I'm trading a $100,000 Canada future, I have one future for each $100,000 in cash. So unleveraged. Sometimes I'm even under leveraged, meaning less than that. So if I buy a stock, let's say I buy, let me throw a number out there. Let's say I buy $1 billion for the stock. I may have $2 billion worth of capital committed to that position, meaning I'm completely under leveraged. But I'm very, very seldom do I use leverage. There are times, but not very often. I don't have to anymore. I know that's not the case with you. That's why it's important for you to go to break even early. It's earlier than me. It's important that you continue to lock in profits and that you take profits, take money off the table at logical areas, and walk away with 3 or 4 or 5 to 1 in your pocket, happy, singing, because then you can go trade 3 or 4 times and not have to worry you're going to be playing with the market. But the market's money, okay? Why 20 minutes? Well, Bob, the majority of hedge fund managers use 240-minute charts, which is half a day. Half of the U.S. is 240. The second half is 240. The first half of Tokyo is 240. The second half is 240. The first half of London is 240. The second half is 240. 20 minutes is a frequency of 240, and it's a relatively active period, so I use 20. There's nothing wrong with using 30. There's nothing wrong with using 15. Use whatever works for you. I just tend to gravitate toward 20s. When I first started trading intraday, so in the 80s when I got my seat at the CME, we used to all print out 60-minute charts, but that's just not the case anymore. Nothing wrong with them. Hey, Matthew, how are you? If you were to trade close to the C pivot, what makes you feel comfortable that you can trust that median line? Well, you notice that I did not trade close to the C pivot. I waited for new buyers to show up. But if you have support underneath that C pivot, that's, for example, when we talked about a mountain. If we have a mountain, the price is coming down to a mountain. Here, let me put a chart back up. Too big. Let me zoom through while I talk. Here we go. As price comes back down to a mountain, you'd have to have a stop underneath prior structure over here. We can't use this same area. Now look, we're looking to buy. C is all the way over here, and we've made new highs. Here's the cascade lower. We've now taken out those highs. That gives me the confidence to buy here. This is a fairly late trade for me on a median line. Generally, I am trading in here, but that's because I have support underneath C. And generally, I'm trying to put my stop not only under C, but also under the A. This one, a little late, but I've got plenty of lows to cover me. Outline how you set and use ATR for your stops. Well, I don't set ATR. I just use a 55 simple period moving average period or 34, either one. It doesn't matter. A shorter period, and then I always use 200, and I use the largest of the two. And my stops always have to be at least that large. And then on top of that, there's some amount of noise. So, for example, if I'm buying here, my stop had at 105.91. It only has to be 20 pips wide because I want to be close to double the average range. But also, it's got to be at least 5 to 7 pips below structure, which is C. So if you go back and look at the chart of yourself, you'll see that my stop is not only 20 pips wide, it's also more than 5 pips below this structure. That's because there should be buyers here. I'm going to give them a little bit of room. That's called noise. So that's how I use average to range. If I go to 60-minute Canada, we move up to 45-minute stops instead of 20. 45 tick stops instead of 20 because of the average to range, okay? Which markets do I trade? Well, that's unfair because I trade everything. For example, I owned a large enough position in Facebook that I would have had to register if Facebook hadn't bought me out of my position. So, you know, I trade Mexican debt. I trade all kinds of weird things. I don't buy houses, which some hedge fund guys do. I also don't buy the Red Sox, which my friend John Henry did. I'm not interested in that kind of stuff. I trade things that fluctuate and that I've done before. So I trade everything. But the 5 markets that I trade right now, if you want to know, Canada, Australian dollar, the Japanese yen. I'm watching bonds. And the fifth one, actually we've done these here, is soy meal. I watch intraday soy meal, and those are almost always day-only trades. I take that back. Another one that's moving in and out depending on what's going on is tick on soy meal and also tick charts on natural gas. So those are the smaller time frame ones that I'm watching right now. Wash and rinse means what exactly? Do you mean an immediate profit turning in a break even or loss? No. I mean that, for example, I told you that I thought this area here was building up stops right underneath. And sure enough, they broke the stops. A whale like me might sell $1 billion, run all the stops, and buy back all of the billion that he sold and more to get long in this area, so that when price is up here, all these people that were long that got stopped out, they've been washed and rinsed, and now they're going to start chasing the market to the upside. Okay? Maybe I'll show one of those next time, a more obvious one. Tomas says, I love when dismissing all these retracements, bear bull market, and other tons of so-called need to know. I don't like them too. I like to trade simple. You clear so much of my mind. Okay, good. Again, I like to trade very simple. And, you know, the longer I've been trading, now I'm at like 42, 43 years, the more it is. Love to you, my brother. Lucy and Sean say hello, and prayers to you. I hope you're doing better. Are you better? I hope you're feeling better. I haven't had time to talk. Kushal, thank you. I'd love to see you someday. Where are you at? You never know. IB could send me someplace really interesting, or maybe Peter will get to see me to send me somewhere. Podcast with Justin Fox. Oh, really? Yeah, no, right. I would love to, you know what? I wish I had a tape recorder with me for those 4 years. And I was around him a lot longer than Michael, although I know Michael from Commodities Corporation, but I was with him before Commodities Corporation was started and watched the havoc when they came to Amos because Commodities Corporation was about to go bankrupt in its first 6 months. And yeah, I'd love to do it. But yes, he is famous. Let me just correct one thing that Michael said, and you say that he said. Michael quoted him as saying, "If I'm down 25%, forget the cheese. Let me out of the trap." Well, no. What he said was, when he realizes he's wrong, he would just say to himself, "Keep the cheese. Let me out of the trap." Again, there are some people that have put numbers and figures on these things that are just wrong. But, you know, I'm not saying anything bad about Michael. I'm just telling you, it was a general statement. Hey, when you're wrong, just get out of the market. Let them keep the cheese. You want the money, okay? Let me out of the trap. I get it, okay? Well, thank you, Rich. I'm trying to give back, and I hope everybody understands that. I'm not trying to sell anything. Cynthia is gracious enough to give people like me an opportunity to help traders that are either not consistently profitable or just starting to make it and want to move to the next level. She provides great educational opportunities. I hope you guys understand it. Not just me. There's other people as well. And that's why I'm here. Algo trading. Sure. One reads all kinds of scary stories about retail traders having no chance whatsoever against these high-frequency traders. Your opinion, please. Irwin, I tell you right now, I can pick at least 15 people that regularly come to Market Geometry that I'll put against any algo trader or any computer that's trying to do high-frequency crap any day of the week, and I'll put up my money. They won't even have to put their money. And I can certainly out-trade any computer and any system, period. I feel a little bit like one of the Russian chess masters, Kasparov, that said, you know, bring me a computer, I can beat him. But I'll tell you what, I can definitely, there's no worry. So forget the scary stories. Forget about these black markets and, you know, algo traders, high-frequency traders. I'll tell you a quick story about high-frequency traders. We had somebody at Market Geometry that was ready for professional trading. I got him an interview with a friend from Commodities Corporation who is about my age, and he decided, well, all the clients want high-frequency trading, so let's start a new high-frequency trading division or area. And he got it capitalized, and by the time a student of mine went through interviewing, his 5th interview, they decided to hire him. On Thursday, they gave him the offer. He called me. He took the job. On Monday, when he showed up, they closed the division. So I don't think much of high-frequency trading. I think it's meaningless. Can you think they're getting better and better? Good. Then I'll keep doing them. Oh, welcome to Arizona. Yeah, you're in Paradise Valley. Great. I love Arizona. I've already told my wife, just bury me here. Bury me with my boots on. How do I spot a mountain? Well, look, it's just obvious. Here's a small one right here. It didn't get filled. If you're in an uptrend, mountains tend not to get filled, by the way. And the opposite are called valleys. In an uptrend, valleys get broken. In a downtrend, mountains either hold their prior support or they don't get to it. It's pretty easy. Just do some longer term charts where there's less noise, and you'll be able to see them right away. What period ATR to use for stops? I've already said 55 and 200. I look at the largest. Simple. The separation bar got to be won by reversing force with the close at the end of the bar as the buyer sellers are there. As you described in your article, are we there yet? By the way, fantastic knowledge. Well, there you go. Yeah, you can go to medianline.com or Market Geometry and look at the free information. If you guys want stuff, don't just come to Market Geometry and buy. I mean, that's fine. We're happy with that. But there's all kinds of free information. There's over 100 articles. There's all kinds of stuff that was done at IB. There's actually some recordings from 2005 with you, Cynthia. I don't want to make you feel old, but in 2003 with Barbara. So there's all kinds of nice free stuff, and you could spend more than a year going through all of that and learning that. So there you go. There's a nice article, Are We There Yet?, which will explain reversing force at the close at the end of the bar. Were all your contracts filled at the exact same price? No, I use both the CME and the cash market for this particular trade. To be honest, this trade was $30 billion. So that's a little bit more than I could trade at the CME. If I could trade every contract at the CME, I would. But I get filled at my average price. Hey, Phil, how are you? Tony, what will happen is, you'll get the recording. What will happen is, as you leave, you're going to get your slides, and then about, 2 or 3 hours later, you're going to get a nice email from Cynthia. They're not going to spam you. Don't ever get worried, but she'll send you the link to the recording. That's it. And you can watch it as much as you want. What is the full name of the mentor you had? Amos, A-M-O-S, Hostetter, H-O-S-T-E-T-T-E-R. And if you Google it, make sure that you're not looking at Amos Hostetter Jr., his son, who owned Cablevision, which is now Comcast, largest video, streaming television in the U.S. That's his son. So I would Google Amos Hostetter, H-O-S-T-E-T-T-E-R space trader, and then you'll get it, or Commodities Corporation. There's very little material out there, David. Unfortunately, we're going to do a small book on him. I think do something with charity pretty soon. But very, very little material on it. Most of it is unfortunately wrong. There's a small pamphlet book that you can buy. Every once in a while somebody reproduces it. Don't waste your time. It was a coffee table book. It's at, are you feeling good, my brother? Okay. On on beans, does that mean that you would have to see a break of the last pivot low, and then, well, that's called confirmation. We can also come up to the reactionary in beans that you're talking about, and then form structure below that high, and then start to make a new high, but not take out the prior high or make a lower high. I'd have a median line in there, and I'd be selling against a down-sloping frequency line. You do not sell against upslopers, okay? So yeah, if it fails to take out the highs, then you can put in a frequency line after you get some mature structure and go ahead and try and enter. What do I mean by separation? I measure from the open or the close, and or my frequency line, and I look at the close. And that measurement has to be 5 to 7 pips. Thank you, Don. Always good to see you. Just forget algo trading. It's overhyped. And high-frequency trading, you know, just give me a break. Sorry. Do you say soy oil? No, soy meal. I don't trade soy oil. I don't like the way it trades. It doesn't mean you can't trade it. I don't like it. But the complex in general, it's made its move for growing season, but now, unfortunately, you know, and the first part of the growing season, or when people were worried, there was ice and snow everywhere in the Midwest. So of course, people were worried that we've had this nice run up. Now we'll see if we can hold it. I'm two-way on beans and corn right now. Steven says, I would like it if you could do one of these sessions and show how to draw lines in different situations. It's all great, but when I try to replicate, it gets tougher. Steven, here's what I would suggest to you, or Stefan, however you produce your name, say your name. I would suggest that you go to longer time frames. Go and practice on dailies. Go and practice on even weeklies. There are less pivots, and use the major pivots and practice drawing on the major pivots. When I have somebody in mentoring, and we have waiting lists for mentoring, and I mentor even people that are, you know, on the board at the exchanges. The very first thing we do is we make them draw highs and lows, and then frequency lines on longer term time frames, because there's less noise. After they get that down, then we'll move them down, okay? Bart, you like the new website? For those of you that you know, Market Geometry got a brand new website, not an upgrade, a brand new, totally different website. And if you haven't been there in a while, go take a look. It's pretty cool. And I give all props to Ed and Holly. They just are the best, and they work really hard for us. And let's see. Usually wait for multiple touches on median lines before entry for longer-term trades. No, as I said, look in front of you. This one has really just one touch, but these are close enough to be called touches. This is abnormally long for me. I usually don't wait this long. What I want to see is, I either want to see a nice touch and maybe even a small break and a close with good separation. And if I've got support over here, I'm basically good to go on this one right here. But this was the first trade of the year, so I wanted to see that, I wanted to make sure that we were out of the cascade, and I wanted to see new buyers. The only way to see that is for this to take out. I'm not usually quite so timid, but like anybody else, I had a great year last year. It was up 525% last year. I never thought I'd see that, and I don't expect to see that this year. I just was, you know, trying to find comfort in the first trade. Aren't frequency lines just trend lines? Yes. How many of you, though, draw? I mean, it's a practice. It's art. Are they trend lines? Yes. It's how you use them that counts, Debbie. But yeah, you won't insult me if you call them trend lines. Any feedback on crude oil? No, to be honest, I don't think it's doing. I mean, Shane, my partner, Shane and I were talking about the other day. Feels like it should be doing something, and it isn't. It says, why so good last year? Great trends or a couple of really big moves. First of all, I literally cornered the market in gold personally by myself twice and with lots of leverage. That was the bulk. I would still be up triple digits. Then the Australian dollar, I caught 17 out of 18 trades on that big short move down. That helped an awful lot. And there was one other trade in there, but right time at the right place with a couple magnificent moves. And if you're there and you're waiting for the opportunities and you hit them, great opportunities. You mentioned that 20 and 240-minute charts are useful. Now, which tick charts are most used and on which contracts? There aren't that many people using tick charts. That's why I like them, Erwin, is that you don't have as much competition or there's not a lot of noise. In soy meal, I use 89 ticks or 189 ticks. In natural gas, I use 89, 189, or 377, depending on the volatility. And pretty much, bonds, I use either 352 if it's very slow or 1444. You basically take a contract and you want to have enough ticks that the moves are graceful and beautiful and swing. If they're choppy and blocky, then you need more ticks. Did I trade coffee long on this move? I did not. We followed it in the evening with the master, but I did not take a position. Actually, some of our people in evening with master did. I did not. Cynthia, getting tired?
No, I'm not getting tired, and I think we could probably keep you here all day. But what I would like to do, just before we do end the session, I see a lot of questions have come in about getting access to the to your slides, as well as access to the recording. So what I'm going to do is just quickly grab the ball back from you, and I'm going to take everyone to the website, because if you haven't been able to locate these after the event, now first of all, wait a minute, hold on a minute. I need to share my desktop.
Here, I'll say this while you do that. This is my favorite part, because there's so much information here, and they've done such a great job building this brand new web page along with the CME, and it just gives. It's so easy to go and get education, to go back and find recorded webinars by me or anybody else, to find out what's coming up. Go ahead. It's wonderful. I love it.
What I'm going to do here is show you that there is an education page on the Interactive Broker website, and there's a webinar section, which I've already gone to. But notice here, there is a recorded section here as well. Now, we do have quite a few recordings out here, so we've organized those, and the ones that Tim does are industry-sponsored. Now, notice that there are quite a few here, so I have filtering criteria up at the top of the page where you can actually locate Tim's name in this list. I'm going to scroll down. Notice it is alphabetical, and as soon as I select that, you'll see we have quite a wealth of presentations here dating back far too many years, Tim, and you're right, it has been a while, but always an honor to be able to host you. And notice all of these are available for immediate playback. Simply click the link. Today's event will be posted here afterwards, but you'll all get a direct link before it even appears on the website. As soon as it becomes available on our servers, you'll get that link and can simply click through and access the information. There's also DVD-like controls that will allow you to fast forward or back up and re-listen to certain portions of the event. So keep that in mind. Now, also want to show you that we do include a notes link here. So this is where you can find all of the slides if you happen to miss them as you're leaving today's session. Now, they are set up for both the live session and the recorded playback to pop up as you leave either of those events. It opens in a browser, so if you don't see them immediately when you exit today's session, you may have an open browser minimized at the bottom of your screen. Simply open that up and you'll find right in front of you will be Tim's information, so keep that in mind. Now, also, I do want to mention we are scheduling webinars, and I'll be tapping on Tim's shoulder in just a few days for the next event. And while we don't have it listed here, I did also want to show you there's a live webinar section. Now, our upcoming events will be listed, and you'll notice here there's the industry sponsored page. And as Pete was mentioning way back a long time ago at the beginning of today's session, we are going to have, notice here, there's a School of Futures event that's coming up in just a couple of weeks, actually 2 weeks from today. So definitely do. And by the way, there's even many of these that are also available as well. So now, want to let you know that even if you cannot join any of our sessions live, that we do record them and send them or send that link to everyone who's registered. So whether you can join us live or not, you can still benefit from the information. Just make sure that you do record or do register, because that way I've got your email address and can send that information back. So let's move back over into our main event. Want to thank Tim Morch. Thank you so much. This has been an excellent event. We definitely do appreciate all the time that you put into this. It's always a wonderful afternoon to get to spend with you. Also, I want to thank the CME group for making today's event possible, for actually bringing Tim and me together all those many years ago, and look what's come of it. Now, it's the CME's group dedication to educating traders that make these events possible. So thanks very much to all of those folks there as well. But that is going to conclude our event today. I do want to
Cynthia?
Oh, what's that, Tim?
Do you realize we're only 8 months away, and we'll be having our 10th anniversary together?
Well, my goodness, then we'll have to schedule something very fun with that.
Yeah, we'll have fun with that.
Oh, definitely. Wow, where's the party?
We'll have it. Well, I don't think Cynthia, we'll have to do it in Connecticut, because I don't think Cynthia's coming down here.
Oh, I can be tempted.
Yeah? Okay, well, if it's in the winter, maybe we'll have it here. We'll come down to Phoenix or Tucson or Prescott. On me, that's fine.
Or we can have it online and invite everyone to attend.
Sure, that's fine, too.
Okay. Well, thanks, everyone. Now, you can all exit today's session using the X in the upper right-hand corner of the screen. And make sure that you do check any of your open browsers for that link to today's webinar notes. So thanks, everyone. Have a great afternoon. And please remember, all trade smart. Thanks, everyone. And a special thanks to you as well, Tim.
Thanks, Cynthia. You all take care. We'll see you next month, second Thursday.
I can't wait for that. By the way, everyone, check our webinars page. As soon as I do get that event posted, we will be listing it on the website so that you can register. It will also be going out in our webinar blast towards the end of the month, so be checking there as well. Thanks, everyone. Have a great afternoon. And again, thank you, Tim.
Thanks. Take care.